exporters. So I'm going to be watching on Wednesday exports out of Brazil and Chile, just to get a kind of sense of what demand is like. And we're not going to get any sense of the Chinese domestic market until mid-March, right? Because we have Lunar New Year holiday, it's a blackout period. So we might get some economic data, but we're really not going to have any color as to what emerging markets are going to do in the meantime.
Earlier, we were asking the question of who's briefing who. Xi Jinping to regulators, regulators to Xi Jinping. How important is Lunar New Year weighing on Chinese government officials?
Oh, I think very much so. I mean, they want to get, great point. I mean, Anne-Marie, they need to get sentiment fixed through the next week or two in order for people to spend, in order for retail sales to pick up. And so, you know, I think it's absolutely critical, the messaging right now. What is President Xi actually discussing with the CSRC? I mean, is it going to be more capital controls? Is it going to be more, regulations on short selling, or is it going to be real stimulus injected in the right places to get, consumers to start spending? They haven't been successful at it yet. And if you look at 2015 as sort of a precursor, it took them a long time to right the ship. And even when equities did peak in 2020, it was far from the peak of 2015, I believe. So, they've got their work cut out for them. I'm terribly not optimistic, but, we'll see.
Can you tell us why they've been so reluctant to do that? A very different approach through the pandemic, say, Europe, US versus China. Why have they been so reluctant? Well,
the greatest 15-year build in leverage and debt in the world history occurred in China, preceding, what we've just witnessed now. So I think, in a lot of ways, President Xi is trying to do the right thing, but the economy is so very big, 1.4 billion people globally. I mean, you just can't, think you're going to put on the brakes and things are going to not break. And it's the same thing with the pandemic. People were playing for that reflationary trade after they reopened. We never really saw it yet. If you look at energy demand, oil demand, Anne-Marie, I think China's going to be a third of new oil demand projected this year. I mean, they're going to be a big driver of it because, they're redoing their refining industry. The margins are improving. Their CAPU is going to go up to something on the order of 89%. So there's a lot of reasons to be kind of bulled up about what's going on in China and how it spills out to the rest of the emerging market space. But as it relates to China, yeah, the verdict is out.
This was the bear's dream of 10 years ago, and you and I have talked about this so much over the last 12 months. The balance sheet recession call that was made years and years ago on China, do you see elements of that right now materializing?
Well, it never did materialize, right? I mean, to the extent that we thought it was. And if you look at the U.S., and we can't compare the U.S. to any other beast on the planet.
Sure.
Now they're, look, the vigilantes are now back, right? So, people are looking at, the fiscal deficit, at debt to GDP, at reserves to GDP here in the U.S. So I think, there is going to be a bit of a heightened focus on value as opposed to carry as central banks cut rates and rates compress globally. It just means that, there's not going to be as much money to be made on the carry side. People are going to have to look for quality. They're going to look for value. And that's where the fundamentals kick in.
I keep thinking about executives in the U.S. and how they handle this, how they sort of deal with the China question, given it's the world's second biggest economy. And there's data that's coming out tomorrow that's expected to show, at least according to Bloomberg Intelligence, that the U.S. trade deficit with China hit its lowest level in at least 13 years, led by a drop in imports. If you take a look at as a share of GDP, those are levels last seen since the early 2000s. How much is this just a taste of what's to come?
Well, I have a question with that. Is that indicative of demand from the U.S. for China goods, or is it supply out of China, or maybe logistics and whatever that has?
You're supposed to answer that question.
I don't have the answer for you.
I think it's so
and you're asking me
distorted
about
now.
policy.
Yeah,
Anne-Marie right here. She can tell you what's going on between the U.S.
Damon,
and China.
as you know, we're looking at places like Mexico, Vietnam, that those Chinese exports are now making one stop there, another stop at another place. Can you really get a clean read on the relationship between China and the United States based on that?
The one thing that is interesting, what is the most liquid way to pay China? It's in the offshore China yuan, right? And one thing that I keep butting my head up against is that if you look at it on both a carry and a value basis, the China yuan is a funder. It's one of the lowest yielders among emerging and developed market currencies. The 10-year now is, I think it's rallied 5 bips today, but it's still at like only 244. And then if you look at it on a value basis, on a purchasing power parity basis, it's pretty expensive still. So those are two strikes against the China yuan, just as a pure investment thesis, as an investment case, as a currency speculator or a risk manager. And so from that perspective, again, it's going to be a tough slog for China investors.
Damon, this was great. You've done too much TV, just asking his own questions and then answering them.
I love it.
Damien, thank you. Damien Sasser of Bloomberg. Coming up in the next hour on Bloomberg TV, Dan Morris, Chief Market Strategist, BNP Paribas Asset Management, Deborah Cunningham, Global Liquidity Markets CIO, Federated Hermes, and George Ferguson of Bloomberg Intelligence on Boeing. A lot more still to come this morning. The second hour of Bloomberg surveillance is just around the corner. Equity futures on the S&P 500 negative here by 0.1%. Live from New York, this is Bloomberg.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
I feel like the Fed is locked and loaded to cut rates if needed.
The Fed has clearly signaled they're done raising interest rates. At some point, maybe lowering interest rates.
We've been June. The data is just not going to turn in a meaningful way before the June meeting.
It's very difficult to get consensus on starting cuts soon when you have not seen the full scale of data yet.
This is a Fed that does not want to make another mistake.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The economic data just isn't turning. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrell. Your equity market on the S&P 500 negative here by 0.1% on the S&P. Bramo, a series of upside surprises upending the recession calls on Wall Street.
Frances Donald put it really well yesterday. She said, you know, there are issues with some of the non-farm payrolls report that are kind of hairy and raise questions about the validity. But you've been wrong if you've discounted numbers that just look too strong simply because they didn't feel right. And that has been sort of a consistent theme over the past 12, 18 months. And frankly, it's being confirmed in the ISM services data as well.
Let's go through that ISM services data together. So the headline number jumped in January, delivering the biggest gain in a year. The new orders read, a proxy for future demand, That rose to a 3-month high. We had manufacturing last week inching closer to expansion. That's been at a slump for something like 2 years. Prices paid for materials jumped the most since 2012. Higher shipping costs, increase in commodities prices as well. So across the board, everything's just picking up all over again.
Which raises this question of where is the slowdown happening? If it was supposed to happen, it's not happening in manufacturing. We're seeing actually things turn up a little bit, as you mentioned before. So then do we get a landing? And then it raises this question, with our Goldilocks, is Goldilocks really having some issues?
Are we back to the no landing story? Is it too early for that?
I don't think so. I think that people are flirting with it.
You said earlier this morning Goldilocks is on life support. What does that mean for the Federal Reserve if that's true?
It means that they're going to probably have to hold rates, if it's true, that they're going to have to hold rates higher for a whole lot longer, and they'll have to hold back. And suddenly we start talking about the potential for it to make sense for the Fed not to cut rates until after the election and later this year.
So let's frame it. So the economic data comes in to start the year looking great. Got a captive audience on Sunday evening, maybe 110, 120 television screens. So you get the offer of doing a pre-Super Bowl interview, and you can talk about all this good stuff, and then AMH, you say no. And your comms director comes out and says, well, we don't really know who's going to be paying attention. They might be getting the chili ready and putting the beer in the cooler box. Not my words, the actual words of the campaign director, comms director of the Biden campaign.
Yeah, it feels like this administration is not taking advantage of those 115 million eyeballs to tout what they have a good story to tell at the moment, which is 2 years of unemployment under 4%. But what we do see the president doing is talking about the economy, but to specific groups. So he was in Nevada yesterday ahead of the Democratic primary, and he went to the Culinary Workers Union. And Jonathan, you're going to love this. When he talked about inflation coming down, he talked about the best economy in the world and more work to do. He said high prices were partly the result of, quote, a little bit of corporate greed going on. So it's not some of the issues you're talking about when it comes to shipping costs or this. The administration is still going to hammer that they think it's corporations' problems.
The two big challenges then. So one, you've got to communicate the economy is as good as you think it is when the electorate so far, and a lot of polling don't agree with you. Two is immigration. So let's talk about immigration. There is a bill that is working its way through Congress. A lot of people think it's dead on arrival. Got a big opportunity to try and communicate the substance of that bill and why you think it's going to help you do a job in a way that you can't do it right now. At the moment, it feels like Republicans and the conservative message has hijacked that bill and spun it in a way that makes it sound like it's not going to address the underlying problems at the southern border.
Right, which is why you see the administration having to come out, and they're going to have to talk about why it will work. Biden says if this bill is passed, it would give him the authority to shut down the border. There's one issue around the 5,000 migrants coming across the border that many conservatives are saying that almost makes it legal for 5,000 migrants to come across the border. Kirsten Sinema has had a lot of issues with this, and she's saying it's being manipulated. She says it just means that if there is 5,000 encounters, automatically the border is shut, giving the president some kind of authority similar to Title 42 that we had during the pandemic.
Last hour, I expressed a lot of frustration about this. I'm not going to rehash that. But what I am going to say is that despite some of the inaction and the sort of paralysis that we talk about Washington, they did pass a lot of stimulus. And if this gets passed, it'll direct a lot of money into the defense complex. And you start to wonder how much that's underpinning a lot of this no landing narrative that we're getting back to. Just to bring it full circle, because this really is what people talk about. When I speak with them, they're just like, there's so much money that's still being pumped into the economy.
Hard infrastructure, the Inflation Reduction Act when it comes to things like EVs, battery plants, and then chips. $166 billion already for chips, the Chips and Science Act. A lot of that is not even out in the field yet. So there's a lot of pent-up demand from this money that will potentially be coming down to Washington. It's not out all of it just yet, but potentially we're going to see some of that.
I can sense the frustration regardless, even when you try and hold it back. You know that, right?
I was trying to be so good. Come on. I thought I was really diplomatic.
Try harder, Bramo.
But look how long those bills took. And then try to get something that's bipartisan when it comes to immigration, something that's been debated in Washington for decades.
And they continue to debate it. Here's the broader price action on the S&P 500. Equity futures on the S&P slightly negative by 0.06%. In the bond market, yields unchanged, 4.1520. In foreign exchange, 107.36 on the euro against the dollar. That currency pair negative here by 0.07%. Coming up this hour, Daniel Morris of BNP Paribas on resetting market expectations. Deborah Cunningham of Federated Hermes on opportunities in the front end of the yield curve. And George Ferguson of Bloomberg Intelligence on Boeing's latest challenges. We begin with our top story. Recession calls in reverse as the US economy drives forward. Dan Morris of BNP Paribas Asset Management saying this: markets are finally waking up to the inflation risk after ignoring it for months. it's clear that the Goldilocks narrative of accelerating growth, but decelerating inflation was a fairy tale. Dan Morris joins us now for more. Dan, let's get straight into that second line, why the Goldilocks narrative was a fairy tale. What are you seeing? What is it about the economic mix at the moment?
I mean, the Goldilocks story made a lot of sense prior to the pandemic. Right? You got to remember what the distinction we try to make between Goldilocks and soft landing. So soft landing is we have decelerating growth, but at the same time decelerating inflation. So that's actually not such a great environment. It's obviously a lot better than a recession, but it's still slowing growth. Whereas at the beginning of this year, we've had this idea that actually you can have 3+% GDP growth at the same time that you have falling inflation. So this idea that you can have stable or improving economic growth, but inflation continuing to decelerate, we just thought that was never credible. And after the non-farm payrolls data on Friday and data since, I think it's put paid to that idea.
So this is really a compelling idea to me, and I was talking about joking that Goldilocks was on life support. You just point out that it's fictional to begin with, but I am curious about, what has to give here? Is it the soft landing aspect, or is it the inflation aspect that it keeps coming down in tandem with ongoing strength in the economy?
Well, I mean, it does seem ultimately growth is going to have to slow, even if the U.S. economy really just refuses to do so. But given that we do believe interest rates are at a restrictive level, how restrictive certainly we can debate all day if you would like to, but they are high, that will eventually slow economic growth. We appreciate the reason that hasn't happened yet is because of all the fiscal stimulus that's been put into the economy. So it's kind of that battle between monetary policy on one hand, fiscal policy on the other, but rates high enough for long enough, U.S. growth will slow. And it also, I mean, it's not just that U.S. growth needs to slow, it needs to slow to below trend growth rate, meaning you need to be probably somewhere below 1.75 in order to get inflation back to target. And clearly, we're a long ways from that.
So just walk us through then how this sort of informs your investment thesis, because you're not exactly bearish. I was reading your notes, and it sounds like you're still constructive, but maybe not as constructive, or you think that things are going to slow later. How do you sort of see this changing your view?
Well, I think exactly it's the timing that we're worried about. I mean, we all appreciate monetary policy works with a lag. Clearly, the Fed is not going to be cutting rates anytime soon. So the previous hikes, the current level of interest rates, that's going to continue to slow the economy. And it's just a question, are we going to see a more sudden deceleration at some point later in the year? So we think that's ultimately what's going to be reflected in market prices. So far, what you certainly see in equities is this very sustained, relatively high level of growth, and we don't think that's going to last. And so when you do start to see that deceleration, and then you will have to see, we think, some weakness in equity prices.
Dan, when you say this is what we see in equities, if you strip out the major tech players, is that really what we see in equities?
I think so. I mean, if you try to say, take the Russell 1000 value index as a proxy for, say, the non-tech parts of the S&P, it still had a decent year last year. You're still looking for 8-9% earnings growth this year. Valuations, actually somewhat comparable to what you see for NASDAQ. So I think even there, there's some justified optimism, but it's just a question of whether the optimism at this level is really supported.
Dan, Lisa and I spent the morning talking about a repricing of interest rates higher and the parts of the equity market that might be vulnerable. We can talk about tech, but let's talk about the financials. Does that just pile on the pressure in the near term on the financials all over again, Dan? And I wonder if the events of last week are truly a one-off, or whether you expect to see more of that still to come in the weeks ahead.
Well, in general, I think if we kind of look at the trade-off or the relative performance of growth versus value, you're absolutely right. On one hand, if interest rates go up, we know the sensitivity of valuations for growth stocks, but you're right, it is going to certainly affect what we see in terms of financials and also energy, which is another key part of the value index. So it's going to be that dynamic on one hand, with driving economic growth, but on the other hand, discount rate via interest rates, that's going to really assert whether or not the growth versus value dynamic continues into this year.
Just to take that a step further, what's the threshold for benchmark rates, at which point it really challenges a host of valuations in the S&P, frankly, also in the Russell 1000 and 2000?
Well, I think if you really thought policy rates needed to go higher, then certainly you would be worried about is there going to be a tipping point in terms of equity markets. Again, for us, it's not so much that we think rates need to go higher. It's just you're not going to get 150 basis points in cuts out of the Fed this year the way the market thought at one point. Powell seemed pretty insistent. 75 still to him seems like a pretty reasonable number. So at the same time, even if we're a bit worried about the outlook later in the year, again, don't want to paint too bearish a picture. Rates are going to go down. Equities, at least from the end of last year to the end of this year, should be in positive territory, but it's now just trying to calibrate what that move should be.
Hey, Dan, it's good to hear from you. Daniel Morris there of BNP Paribas Asset Management. Let's go back about a month or so. Let's go to Max Kenner of HSBC. We talked about it already this week. I think it's worth going over, Lisa. So for the whole of last year, he's constructive on risk when other people aren't. He's sticking with it through the banking stress of last spring. He's sticking with it even as the Federal Reserve continues to increase interest rates. Then you get to 2024, and he changes path, he changes course, and he writes this. The biggest risk is not from a sudden deterioration in earnings activity, but another repricing in rates. And what we have, I know it's only the last couple of days, but we've had a repricing in interest rates higher off the back of January data. So the ultimate question right now is how much weight do you put on the January economic data? We've been talking for months, Lisa, about the spread between services and manufacturing. And how would that spread close? Would services come down to manufacturing, or would manufacturing ultimately come up to services? What have we seen in the last month? This is starting to happen. Manufacturing coming up to services.
And it's even before some of the fiscal comes into play, which will only fuel even more growth in certain areas. It just does raise a question of whether, A, rates are truly restricted. I'm not talking about another leg higher in terms of policy rates. This is different. We're talking about rates truly staying higher for longer, taking Jay Powell at his word in order to sort of curtail some of this momentum. But also to your point of, do we take this data on its face value? That's why people are looking at CPI revisions on Friday.
Yep.
How much are we going to get some revisions that maybe give a gut check, given that some of the anecdotal data doesn't really confirm what some of the headline numbers say?
It's always worth repeating that this is just an observation about where we are, not about a judgment of where we're going. But ultimately, you get another month. If February data looks like January, then you really start to get a shift in terms of the probability around a range of outcomes. And we move away from this soft landing talk. And we go back to what we were talking 12 months ago. What landing? What landing?
And then no landing will lead to hard landing, because that's essentially what we keep hearing from everybody, is that the deceleration will be sudden, and you'll have to turn the screws up on the economy as inflation comes down in order to keep inflation lower. So yeah, we're going to basically do a repeat of last year.
It's early days, but it's an interesting start to 2024. Equities right now on the S&P 500, negative hit by almost 0.1%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Spotify is higher in the pre-market trade after first quarter subscriber growth topped estimates. Premium subscribers rose 15% and monthly active users rose 23%. Overall sales for Spotify reached 3.6 billion euros for the period, just short of estimates. Spotify, meanwhile, laid off 17% of its staff in December and raised monthly subscription prices by $1 in the U.S. Shares of UBS are falling this morning after the bank's fourth quarter earnings missed estimates. UBS did announce it will buy back up to $1 billion in shares this year and increase its cost savings target. CEO Sergio Armati says 2024 is a pivotal year.
I think that one thing that we need to do is to be willing in the next couple of years to sacrifice a little bit of top-line growth in order to improve the returns on our financial resources, particularly on the balance sheet.
Red Bull is investigating Christian Horner, the team principal and CEO of its Formula One team, over accusations of inappropriate behavior. Horner has denied the accusations. I spoke with the team principal at one of Red Bull's rivals, Williams Racing, who said it's important to have an accepting culture.
These allegations are allegations. I'm afraid I don't have any understanding of what is behind them and the significance of what has happened. All I can say that should this ever happen in our regard, we'll be entirely supportive in terms of fixing it and making sure we have a culture that's accepting of everyone.
And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate the update. Up next on this program, pursuing the Fed's objective.
The price stability objective is clear. We pursue 2% inflation over time. Supply and demand for labor are more aligned, and wage growth across the pay spectrum is settling back into more normal patterns.
That's coming up next on the program, live from New York City. This is Bloomberg TV.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Two hours and about 13 minutes away from the opening bell. Getting bullied around the desk.
Oh, come on. That
Good
was
start
not
to the
being
morning.
bullied.
Equities on the S&P 500, negative by 0.1% on the S&P. Yields unchanged, 10-year, 415.78. Under surveillance this morning, pursuing the Fed's objective.
The price stability objective is clear. We pursue 2% inflation over time. Supply and demand for labor are more aligned, and wage growth across the pay spectrum is settling back into more normal patterns. It's dangerous to proclaim with certainty that any pandemic-era phenomenon will shape future labor markets. But these are all potentially significant developments that could be particularly important drivers of labor market dynamics in the future.
Here's the latest this morning. Atlanta Fed President Raphael Bostic saying the central bank's inflation target remains at 2% and that wage growth and labor supply are normalizing. Bostic opting not to comment on the timing or path of interest rates in his prepared remarks as speculation grows as to when we might see the first interest rate cut. Julia Coronado of Macro Policy Perspective suggesting the time is now, writing this. The question is very much, what are we doing at 5.5%? It's time to start adjusting the nominal funds rate. Julia Coronado, I'm pleased to say, joins us now. Julia, let's talk about that. The chairman of the Federal Reserve in the news conference last week said we need to see more data, more good data, not better data, just more data.
Not even necessarily as good, just good, he said.
So any reason to believe we won't see that in the next 3 months?
There is no real reason. Of course, you need the data to ratify that. And as we saw on Friday, data can always surprise us. But if inflation does continue to behave as it's been, they're rapidly approaching 2%. And so I think what we're hearing from the Fed is that the committee is a little just, struggling to catch up to how quickly the data have moved and what to make of that. It certainly defies all of our macro models for inflation to come down so rapidly with the labor market so healthy. And so there's still some skeptics. I think Chair Powell might be having a challenge corralling everybody on the committee. I think he wants to make that first move based on a strong consensus. And I think he's just having a little bit of committee management challenges, which is why he, in a very data undependent way, took March off the table. So we're in May because we think the data will continue to tell the story.
Julia, Lisa said it immediately after that Fed meeting. During that news conference, I think Lisa said to us around the table, it's like herding cats. Julia, you noticed the same thing. What was it about the statement and the news conference that stood out to you that gave you the impression that maybe things are really fragmented, divided on the committee at the moment?
For me, the moment that was most telling was when he took March off the table. He said it in a sort of halting way that he just doesn't think this committee will have the confidence by March. He thinks it's unlikely, I think was the term, but it was a reference not to his view, but to sort of the collective confidence, which suggests that there were some people that were just digging their heels in still, that just deeply skeptical of what they've seen or that it's likelihood of continuing. But yeah, I think that was the moment where it was like, well, that's not data dependent, and it wasn't referencing his own views, which we know that Chair Powell's been a bit more encouraged and optimistic about the data flow, more willing because he's perhaps not an economist to just accept it for what it is and buy into its staying power. Again, data have to ratify it, but should they ratify it, you know, there's no reason not to move in March. Well, there's tension right now between the Fed saying they're going to start the cutting process well before we get to 2% and taking March off the table, right? Because we are getting very close to 2%. And by March, with a couple more months, we could be quite close. But I think it's just the herding cats challenge.
Julia, you said it is pretty clear that the Fed has policy in a restrictive place. Is it clear? I mean, this is actually, talk about herding cats. It's herding cats in the market too. You've got an increasing number of people questioning just how restrictive that is. If you're seeing job growth like what we saw on Friday, if you see ISM services prices paid grow at the pace that we did for last month as well.
Yeah, no, that's a fair question, Lisa. I think one of the things that's been the huge macro surprise of 2023 was the productivity boom. We had been bullish productivity, that it would be strong in 2023, that it would help bring inflation down and make the Fed's trade-offs easier than they expected. But it was much stronger than we expected. My goodness, the second half of the year was a productivity boom. For the year, it's close to 3%. That's quite a performance. Now it comes after a very bad performance in 2022 when supply chains were dragging us down. But it's masking, I think, some of the restriction in monetary policy, which could mean that the neutral rate, at least for now, is higher. And the big question and the big uncertainty, and Chair Powell touched on this in his press conference, we just don't know if we're going to keep getting productivity gains like we saw in 2023 or even anywhere close. If we do, if we are not just in a productivity sort of post-pandemic dividend, but a stronger trend, then the neutral rate could be higher.
Yeah.
On the other hand, if this is just a one-time productivity dividend, then we could see a sudden stop in the economy as that slows down, and the restriction would come through and they'd have to cut a lot faster.
Julia.
So I think those are the uncertainties we're facing.
We just have about 60 seconds left. Do you believe in Goldilocks, or do you think that maybe it's kind of a little bit inaccurate at this point?
I do believe in Goldilocks. I've been pretty bullish productivity. I do think the trend is better. That could mean a higher neutral rate, but what is higher? It's not 5.5. It might be 3, but maybe 3.5. But I do think that productivity is higher, and these trade-offs are going to continue to be, what the Fed, the Fed's dream come true, at least for now.
Somewhere in this country this morning, there is a child waking up who put on Business News Bramo on accident instead of the cartoons. And hear you asking, do you believe in Goldilocks? And this child is fixated now by two adults discussing whether Goldilocks is real or not.
Well, welcome. That's all I could say. We could talk about Fed policy another time.
Julia, thank you. Julia Coronado of Macro Policy Perspectives. Julia, just brilliant. Away from whether Goldilocks is real or not, to Julia's point, you sensed it too last week, herding cats on the FOMC.
It just seemed like there was some sort of gap, disparity between his view and what he had to read and stick to for that statement. He seemed to sort of have more conviction in the 60 Minutes interview where he laid out exactly what it is. It's just sort of interesting. I wonder kind of how heated those conversations are.
60 Minutes a bit more comfortable speaking from your own perspective, your own thoughts, your own opinions, reflecting the consensus of the committee in the news conference is tremendously difficult to do. And I think we saw that last week. Equity futures on the S&P 500 negative here by 0.1% from New York City. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Equities a little softer here on the S&P, the Nasdaq, the small caps, the Russell down across the board. Just to kick off this morning, we're negative 0.1% on the S&P. Likewise on the Nasdaq 100. In the bond market, big readjustment the last 2 days. Let's check it out. The 2-year, 4.47, Lisa, after 2 days of double-digit gains on a 2-year yield.
People are almost entirely pricing out the idea of a March rate cut. Now the question is, are they just going to backload them? Are they going to wait for weakness and then cut by 50 basis points? How many people have you been talking to who say, actually, it just means that they're going to cut that much more aggressively later in the year? Key question to me is, are we heading back to no landing? Are we heading back to an idea that this is sustainable, this kind of growth and expansion? And that really raises questions about how much they can cut it all.
HSBC running a counter-consensus call from late last year on this week dollar call. They're looking for a resilient dollar. That's what you see on the screen right now. Euro again negative by 0.1%, 107.27. This has been a grind lower on the euro over the last week.
And frankly, they're not alone. Steve Englander over at Standard Chartered came out and basically said you could see even more dollar strength just because you have the ECB moving in possibly the opposite direction with data that justifies it. And in the U.S., again, we're talking about surprising resilience with more fiscal stimulus coming down the pike.
Dollar index, strongest dollar of the year so far, there and thereabouts. I think the highest on DXY going back to the middle of November. That's the dollar, the FX market under surveillance this morning. Here are your top stories. The US border and Ukraine aid deal nearing a collapse, with Republican senators saying on vote tomorrow on the $118 billion bill would be too soon. The bill would unlock significant aid for Ukraine and impose new US border restrictions. GOP presidential frontrunner Donald Trump leading the pushback on the bill, calling it, quote, a death wish for the Republican Party. AMH, translate all of that for us.
Well, this is something that actually for sure is on life support. But what you hear from Republican senators is, especially many who wanted to link these two items together, we're not going to give foreign aid until we fix our southern border. What they're saying right now, Mitch McConnell behind closed doors says this, according to Punchbowl. The view is that the problem isn't the bill, it's the politics around it. When you have the former president, who's now your front runner to become your GOP candidate into November, potentially the next president, is saying this is a gift to Democrats. I want to run on this issue. Do not give Biden this win.
If that's the case, does the electorate fall for it? Wall Street Journal editorial board yesterday evening put this one out. If Republicans reject this bill, they will hand Democrats an argument that the GOP wants border chaos that they can exploit as a campaign issue. At the moment, it's clear in the polls that the blame is going to the White House and certainly not to the Conservatives. That poll on that issue is going to be the one to watch in the weeks and months to come if this bill doesn't pass.
Well, that's why I agree with Senator Lankford, who says I'm not going to have a funeral for this bill yet, and that's why I say it's on life support. If this drags out, the electorate is smart. They're not just going to blame Joe Biden because he's in office, but they're also going to start to look to the Republicans and say, look, it's a split government. This is a bipartisan deal. Why are you not signing up for it?
You know, no one needs to hear my rant again about politics versus policy, but it does raise a question about turnout. Because if you see this kind of thing, people are going to turn out to elections if they feel really sort of disenchanted with, you know, the politics versus policy.
Doesn't this push turnout? Doesn't this get people to go to the polls because they're so fed up with who's in Congress right now?
And then who do they vote in?
More of the same?
I mean, that's essentially what we're talking
Politicians
about.
are self-interested people that only want to get re-elected. Really?
I mean, okay, well, we don't need to go here. But my point is, there is this frustration, and yet people are watching this because it does determine a lot of the funding and also, you know, frankly, from market's perspective, how you price in different policies.
I'm shocked. I'm absolutely shocked that those people exist. I know some of them listen to this program. Not you, of course, everyone else. Let's get to Deutsche Bank. They're dropping their call for a US recession. They've got this to say. Chief US economist Matt Lazzetti saying the economy performed as well as it could have last year. And quote, "We now think the economy will land on this narrow path and that a recession will be averted with limited cost in the labour market. Although inflation could firm some in the near term, we ultimately believe it is sustainably falling towards the Fed's target." I think we've really got to frame this together, Lisa. What a change this is for Deutsche Bank, who going back to April 2022 said late 23 recession. They got their Fed call right. Interest rates would go between 5% and 6%, so absolutely nailed that.
Correct.
And then pretty much like everybody else, got the consequences of that move totally wrong. Thought we'd have to see pain in the labour market, unemployment's below 4% for 2 years. Thought we'd have to see that pain to get inflation back down towards 2%, and there is a hope we can achieve all these things without a recession.
Now actually making that their base case, saying that unemployment will simply rise to 4.1% versus their expectation for a much more material increase in unemployment. This is sort of what you feel under the hood. And it raises this question, what does it do for policy rates? What they say is it means that the Fed can cut by 100 basis points. I believe it was 175 basis points before this. But longer term, and this is sort of the key, what does this mean about where the rate can be to keep the economy chugging along? It used to be 3% according to them. Now it's 3.5%, maybe even 4% over the longer term. To me, this is one of the key questions as people reassess the refinancing wall and exactly how sustainable some of these rates are.
That'd be a game changer for the stock market too.
I would agree.
You know, there's a real hope that we're going back to this old world pre-2020 and that we can get going again in the equity market. It's a real big challenge. A challenge to what, though, is the question I keep asking this morning. A challenge to the multiples on big tech, which are sort of blowing it out of the water when it comes to the earnings, or a challenge to the financials, which really struggled last year?
It's a great question. I don't know the answer. If I did, I probably wouldn't be here. But I do think that it's going to be really interesting to see whether the Russell 2000 is actually a tea leaf of what's to come. Because some of these businesses are ones that have not fully had to refinance, haven't really had to face the music, haven't had to divert cash away from their equity holders and put it toward their debt holders as they reassess a new platform. Is that kind of maybe what the devaluation is sussing out?
That's the latest from Deutsche Bank and Matt Lazzetti. Matt, thanks for sending that call over last night. Fascinating read. Want to finish on this. Boeing. Executives dealing with an ongoing safety fallout could have a new issue on the horizon. Labour talks. Boeing's largest union set to demand a 40% pay increase over the 3 or 4 years, hoping to capitalise on a resurgent US labour movement, short supply of aerospace workers and pressure on Boeing to stabilise work at its factories. The union warning of potential strikes in order to get their wish. AMH, more bad news for this company potentially.
How can they deal with this on top of everything else? And the union is saying, you know, we don't take striking lightly, but we're willing to do it. So it seems like they have a lot of leverage right now in this moment because Boeing is dealing with just a plethora of issues.
After UAW, we did ask the question, is this a sign of the times, a new era, regime of labour power, or just the sort of dying embers of the story coming out of the pandemic? Which one is it?
A lot of people were saying it was probably the latter, dying embers. I would just point to dying embers. I would just point to UPS earnings and the fact that they came out and announced cuts, pretty significant cuts after some of their labor negotiations. Again, a real question of exactly how this is going to shake out.
It's weird to compare the data with the anecdotes, right?
Yes.
And some of the examples you're seeing from corporate America. We saw cuts, I think, from Estee Lauder as well yesterday, coming off the back of just a blowout jobs report on Friday. It's been example after example over the last few weeks of companies not hiring, but firing.
And you see this in the tech space as well. I was actually reading about this yesterday, and they were talking about the churn underneath the labor market. How much of this is normal, seasonal, and how much this is people reallocating workers to other areas. But it does raise a question about the headline numbers.
Let's turn back to the market. Equity futures just a little bit softer. Yields basically unchanged in the Treasury market after recording their biggest two-day decline in months. Federated's Deborah Cunningham writing this: investing in the front end of the curve improved last month as markets pushed out forecasts for a March rate cut. Trades are now more in line with our view of 75 basis points of cuts this year, having us find more value along the curve than when Fed futures called for upwards of 6 rate cuts. Deborah, I'm pleased to say, joined us now for more. Deborah, let's get into the March meeting. A lot of people pouring freezing cold water over it, but this one could still be interesting, and I know you're focused on it too. There's going to be a big conversation about the balance sheet and maybe winding down QT. What are you expecting from the Federal Reserve in a few months' time?
Well, I think there will be more details on how the QT process goes forward for the rest of 2024 and, into 2025. So I think that will be the focus of the meeting. I also think the resilience of the economy, certainly this jobs number that we just saw, we get another labor report, obviously, before the March meeting. So additional information there. And then, what happens from an inflation perspective going into the March meeting. I think those will all be top of mind. Having said that, I don't really see much change in the current path that we're seeing, which is continued wage inflation, continued strength from an employment perspective, maybe some stickiness from an inflation perspective, given where we are from a wage inflation and a rents perspective. What you were just talking about from a union and the UAW settlement earlier this year or last year, what's going on with Boeing now. It seems like the stage is set for the Fed to have a slow decline in rates, nothing that's precipitous, nothing that's, meeting after meeting, starting in the spring of this year. We're really of the opinion it's a second half event.
Deborah, you are the key person I wanted to speak to because this raises a question. If rates aren't going down so quickly and they're not going to go down so much anytime soon, is there really so much cash on the sidelines, or is it very happily parked in money market accounts and short-term debt?
I think it's very happily parked. If you look at the money market industry last year, it gained $1 trillion, $1.1 trillion. If you look at deposits lost $1 trillion. That's not a coincidence. There's something to be said about what came out of deposits and went into money market funds. So I'm not saying that there's no cash on the sidelines. There are certainly those that are using the liquidity markets, the money markets as a safe haven. In the context of, no longer in the equity market, no longer in the longer term fixed income market. But the resilience in the market, I think from a, cash longevity standpoint is there.
Which raises a question, Deborah, of how much of the $6 trillion in money markets actually is going to flow into risk assets later this year. That's been really one of the bull cases for a lot of stock market prognosticators. How much do you sort of view this as something that hinges on Fed rate cuts versus just a fallacious argument?
Well, I actually think Fed rate cuts will prompt more cash into the liquidity markets, into money markets in particular. Generally speaking, the trade last year came from retail. So the flow came from retail and it came out of deposits. What happens when the Fed plateaus from a rate standpoint and starts to go down the other side? Institutional cash starts coming into the marketplace. It comes out of direct securities because the direct securities are now lower than what the managed product is that has a weighted average maturity of 40, 50, 60 days. So ultimately, there may be some amount, let's call it a couple $100 million or billion that flows out because of their re-entrance into the riskier asset markets. Having said that, I think the assets in these products continue to increase in 2024, given what are expectations for rate cuts of 75 basis points to maybe 100. I mean, you're still talking about rates at the end of the year, 4 to 4.5%.
In the meantime, though, no rate cuts, at least maybe until the middle of the year, based on the way the consensus is shifting. Deborah, can we just finish?
That's our outlook at this point.
Can we just finish then on the banking system? If that is the case, given that the bank lending program that was designed and implemented by the Federal Reserve last year is set to expire next month, how much stress is accumulating in the regional banks at the moment, based on your read of things over the last few months?
Jonathan, it seems like the larger regional banks are quite, fulsome at this point and don't have the same, what I'll call geographic risks and concentration that something like a, community, more the community regional banks have. So the system, the bank term funding program was designed for the larger regional banks. And right now, they seem to have much less stress. Their stress came last year because of the rapidly rising rate environment. That's behind us at this point. And so the stress in their asset portfolio should be back to what the traditional stresses would be, the loan portfolio. And for the most part, they're fairly well diversified in that regard.
Got it. Deborah, appreciate the update, and thanks for joining us early this morning. Deborah Cunningham there at Federated. I say early because Deborah has such a more active social life than I do. Out at Madonna overnight at a concert. What time did you go to sleep last night? 8 p.m.?
I don't want to talk about it.
How sad is that? How sad is that?
Yeah,
Good for them. Good for them. Equities right now in the S&P negative by almost 0.1%. No drama there. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bloomberg is reporting that behind-the-scenes talks between New York Community Bank and the U.S. watchdog led to the surprise decision to hoard cash and slash its dividend. The bank says the drastic moves last week were part of an expected transition to tougher capital requirements. NYCB took on assets from Signature Bank last year, including a couple of risky loans and commercial real estate. Toyota's market value has climbed to a new high, topping 50 trillion yen for the first time in its history. That's just under $340 billion. Shares jumped in reaction to an upward revision to its full-year profit guidance. Toyota shares are up 64% over the year on the back of strong sales and a weaker yen. The new guidance did exceed analyst estimates. And Aston Martin is shaking up their C-suite again. The company is searching for its fourth CEO in 4 years. According to Bloomberg sources, current and former heads of other luxury auto manufacturers have been contacted to succeed current CEO Amedeo Felisa. Felisa has been the CEO of Aston Martin since 2022. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. 4 CEOs, 4 years. Lisa, at this point, do you get a new recruiter?
I mean, at a certain point, you have to come up with a new thesis as far as what you're looking for. I mean, at a certain point.
That was shocking seeing the headline cross a little bit earlier this morning. Up next on this program, more headwinds for Boeing.
We caused the problem, and we understand that. We instituted additional quality controls and inspections at Boeing and at our supplier.
That's coming up next on the program, live from New York City. This is Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities on the S&P 500 futures just a touch negative. We're down by 0.04%. If you want to move her, check out shares of Hertz this morning in the pre-market down here by 7%, Bramo. Numbers out in the last hour.
Reporting bigger than expected losses. Why? Because of electric vehicles. Talking about offloading 20,000 Tesla EVs. It's about a third of its fleet. And talking about how expensive it was to repair them. The residual values were declining. Basically, we're talking about a CEO came out and said, we continue to face headwinds related to our electric vehicle fleet and other costs throughout the quarter, after previously having been the one to lead the charge in this way. It just shows the hiccups and the growing pains in this transition that we've been talking about.
Well, the push to EV for Hertz was sort of one part seeing the future and one part a marketing gimmick, right? You get Tom Brady on board, you push this, it makes you think, yes, let's hire from Hertz, let's go get an electric vehicle. Away from the consumer demand story, what you said just then, I think, is the critical element of Hertz that we didn't discuss nearly enough. The cost of keeping these vehicles, the loss of value over time, that was what was behind this decision, not just the fact that consumer demand wasn't there in the way they anticipated. It was those issues too.
And I have to say, when I was thinking about buying a car, there was a real question if you're going to have EVs that are going to be much better and more developed and cheaper potentially later on. Why are you going to hold on to it now if you're not going to get the same kind of value later? And this has been a real concern, and you could see it in practice at Hertz.
Well, it's a complete roundabout from 2021. They bought 100,000. They wanted this to be a massive push into this market, but the demand isn't there, and it's not just for Hertz. You have a number of dealers writing to the Biden administration saying, you need to slow down on this ambitious plan for the electric vehicle grid of the United States because the demand isn't there. There's a lot of range anxiety. The cost is an issue. And we're seeing the fallout, really, of potentially moving too fast on the transition.
Well, Secretary Kerry, what did he say? That the range anxiety was a consequence of a misinformation campaign.
Range anxiety sounds like something that happens to a dog.
I know. Look at GM. You talked about some of the dealerships. The dealerships writing to GM and to Mary Barra and basically saying, we want the hybrids. Caught up with Mary Barra last week, and what did Mary talk about?
Hybrids.
Hybrids. Now, that's a big change for GM. They didn't want to go in that direction again.
There's a reality check. Question is, is it just a bump in the road, or does it change the course of the road? A lot of people saying it's a bump in the road, but it's really going to slow things down.
Excuse the pun. Hertz is down by 6.9% in the pre-market.
I'm proud of it.
You should be. Under surveillance this morning. More headwinds for Boeing.
We caused the problem, and we understand that. We instituted additional quality controls and inspections at Boeing and at our supplier. We issued bulletins to suppliers to strengthen the focus on conformance and reducing the risks of quality escapes.
So here's the latest this morning. The company finding more misdrilled holes in the fuselage of its 737s. Boeing also facing a potential labor battle. Union leaders asking for a 40% pay boost for workers over the next 3 to 4 years. FAA Administrator Mike Whitaker set to testify on Capitol Hill today. Whitaker, in prepared remarks, saying the FAA will, quote, consider the full extent of our enforcement authority to ensure Boeing is held accountable for any non-compliance. George Ferguson, Senior Aerospace and Defense Analyst at Bloomberg Intelligence, joins us now for more. George, can you just frame how much of a nightmare this might be for Boeing later on today?
Yeah, well, I mean, I think it's no CEO would want this to be happening, but I don't think there's much choice, right? The FAA, I think their reputation's been hurt by Boeing, and I think as the regulator, they really need to get in there and make sure the manufacturing process is stable and Boeing is building safe airplanes. If we had a problem, God forbid, right, it would be part of it would be on the FAA's hands. And so, yeah, again, well, no CEO would want this to be going on. I think it's necessary at this point. And I think a lot of it's going to be about, increased oversight at Boeing, at the manufacturing facilities. And there'll be questions for the FAA too, right? Whether or not they've got the personnel in place and the resources to go out and properly oversee Boeing.
Is it the job of the FAA or Boeing, though, to make sure that planes are safe?
I mean, at the end of the day, it's Boeing's job to build an airplane according to what they've had certified by the FAA. So it's Boeing's job to build a safe airplane and build it correctly. But it is the FAA's responsibility to oversee that process, right? And so there needs to be appropriate controls in place and inspections in place so they can feel satisfied that the work is being done according to their authorizations.
George, we were talking about some of the labor issues issues and the potential for a strike. And I wonder how much this is just yet another problem and how much this is front and center, central to the problems. How much is Boeing's issue a workforce problem with respect to morale, with respect to retention, with respect to just full staffing?
A lot of it is workforce. I mean, everyone I talk to in the industry talks about the turnover we had after, during the pandemic and the difficulty getting workers even now. And so, look, the unions are going to have plenty of leverage here. The workforce still seems, or at least the U.S. workforce still seems like there's shortages in some areas. So I'd expect them to get a nice pay package. But again, I think the primary challenge here is the turnover has really depleted the amount of experience on the line, and they need to be able to retain that experience, so they can build airplanes well. Aircraft manufacturing is much different than lots of other manufacturing. In lots of other manufacturing, you do higher volumes and you do a lot more templating. You do a lot more. You'll buy a lot more capital tools that will help make up for perhaps any deficiencies in the workforce. There's a lot of manual labor that isn't capital tool accompanied in this business. And so you need smart people, well-trained people on the line, focused on detail. And it's hard to do. They're going to probably get a pretty nice pay package.
George, can you help us quantify that? What are we missing now that we used to have before the pandemic?
I think a lot of gray-haired, experienced folks sitting on the line, right? That's the big difference is that prior to the pandemic, we saw a lot of seasoned professionals on those lines. During the pandemic, they left. They decided, I guess, they were going to move to Jacksonville or something, right? They went through Florida, nothing wrong with Jacksonville, but I'm just saying they were sunnier shores than the Northwest. They were in an industry that saw the MCAS problems with the MAX, the 2 crashes. So the MAX was grounded. Next thing you know, you get into a pandemic. Air travel goes to almost zero. There's people that just threw up their hands and said, "That's it. I'm 62 or whatever. Boeing's going to offer me a package because they're trying to cut longer term costs. I'll take their package. I'll move out of here. I'll go do something else." And then they had to turn that staff over, bring new people in, train them. And that's been a serious challenge.
George, you've been great on this story for us. It's good to catch up. George Ferguson there of Bloomberg Intelligence on the challenges for Boeing, but also for Spirit Aerosystems. Spirit Aero suspending guidance. No surprise there. Bramo saw the same thing from Boeing in the last few weeks.
How can they provide guidance? They don't even know what the parameters are of their new regulatory regime, and they don't understand what kind of blame there is. At this point, I do wonder why this has not been a more talked about area. It has been all Boeing. It hasn't been some of their subcontractors and what's going to happen. And the assumption is they're going to stay subcontractors and they're going to figure it out.
The amount of books that are going to be written about workers and how many we lost after the pandemic and the amount of people that retired, the experience that retired that is almost sort of irreplaceable, which is what George is getting at.
It's such a human story. We talk about these numbers, but this is a human issue because this is a very detailed craft-focused type of practice.
What do you say on the beaches of Florida? Is that what he was talking
Jacksonville,
about?
but then he pedaled that one back. Not offending anyone in Jacksonville.
Coming up in the next hour, Daryl Cronk of Wells Fargo, Lara Raim of FS Investments, Javier Blas of Bloomberg Opinion. All of that in the third hour of Bloomberg Surveillance. That's next.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
This market is extremely powerful to the upside.
What we're going to see here is a broadening out in quality growth.
What happens from here is a broadening to other areas of the market that aren't necessarily as risky as we think.
When we think about a broadening out, we think that there's an opportunity here for small cap to catch up.
This market is ready to rotate and wants to rotate.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Then there's a group of investors that want it to rotate at some point in the near term. From New York City this morning, good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500, almost unchanged. All that talk about rotation, improving breadth, going away from big tech and going elsewhere. Let's do the year-to-date scores. Year-to-date, the equal weight is down on the year. The Mag 7 is up by something like 8 or 9%.
There has been a rotation. It's away from the Mag 7 to the Mag 4. That's been the rotation. So now it's more consolidated in just a few names.
Who's the Mag 4 now? It's Meta, it's Microsoft, what's left?
NVIDIA, and it's Amazon.
There we go.
There you go.
Don't need anything else.
No, that's basically what's outperformed.
How much is that distorting what's happening elsewhere in this equity market? When you and I talk about good news being good news, has good news been good news for this stock market?
Not for a lot of the small caps, not for a lot of the other stocks that have lagged behind. We haven't seen that rotation. That's the bottom line, that people are saying, just wait. It feels like deja vu all over again from last year. Basically, people saying it was going to broaden out, people saying that we were going to get some sort of weakness. We're not getting either.
Just ripped.
Exactly, and it's basically put 2023 on repeat.
And we were talking about no landing in the economy, and here we are off the back of ISM services, absolutely ripped, on the back of payrolls, blowout jobs report. We're talking about the prospect of moving away from Goldilocks.
Yeah, talking about, yet again, no landing. So are we just in 2023, press repeat, and let's go? Or is there something different to this tenor that's going to be maybe something that comes to the fore middle of the year?
I think the politics are fascinating, and the way the politics is starting to shape what's happening in equity markets at individual companies. So yesterday we had McDonald's. McDonald's were basically complaining about what was happening in the Middle East, and ultimately it was hurting their bottom line. We saw it from Starbucks, Anne-Marie, in the last month as well. So we've had McDonald's and Starbucks, which are like the poster child for international business flying the American flag, which aren't doing so well because of what is developing in the Middle East.
You had on social media in December take place, boycott McDonald's, boycott Starbucks, because customers didn't like what they were saying about what was going on between Israel and Gaza. Also Coca-Cola, and we spoke to the CEO in Davos about the fact that they are having issues in Turkey. Turkish Airlines wanting to get rid of Coca-Cola. How much are these going to become bigger problems going into this year? Not just the Israel war with Gaza, but also a U.S. election that's very tenuous, very emotional for a lot of people. And what does this mean for corporate America?
McDonald's CEO said it's probably going to continue as long as the conflict goes on. But McDonald's not saying that their U.S. stores saw any impact. Starbucks, however, seeing, I think, a same-store drop of about 5%. And saying that it had to do with this.
This goes back to something we've talked about in the last couple of weeks. How much of a challenge is it going to be for the multinationals over the next 12 months? So this is just the politics. Never mind the economics. Europe looks dreadful. China looks like a challenge. We had Apple last week, which I think spoke to all of these themes at the same time.
This is the reason why people want things to broaden out. Go back to the small U.S. companies.
Yeah, they wanted
I mean, this is essentially just a roundabout reason for exactly why people are calling for a broadening out. But really what it is just it's confusion for all the stocks except for the Mag 4, Mag 2. Let's see how long it takes before we have a Mag 1, NVIDIA, as Michael Wilson was talking about. And, you know, that's the only thing that kind of consistently works.
The whole market standing on the shoulders of NVIDIA.
100%.
For 2024, maybe. Equities right now on the S&P 500, totally unchanged. Adjustment in the bond market, we'll discuss that in a moment. In the bond market over the previous 2 days, a move of more than 20 basis points, almost 30 basis points higher at the front end of the curve. On a 10-year, further out along the curve, the 10-year almost unchanged at 4.15, 4.14.81. The dollar just a touch stronger, euro weaker, 107.37 on that currency pair. Coming up this hour, Darryl Cronk of Wells Fargo delivering a reality check for markets. Laura Rame of FS Investments on her surgical rate cut call, and Bloomberg's Javier Balas on big oil's hot streak. All of that still to come. We begin with our top story. Stocks inching back from all-time highs as Wall Street rethinks rate cut bets. Darryl Cronk of Wells Fargo saying this: recent data only further confirms our belief that the first rate cut would come in June or later. The market is still overly optimistic on the number of cuts and when they start. Our view is 3 rate cuts this year, starting in the second half. Darryl, I'm pleased to say is around the table. Morning, Darryl.
Good morning, John.
Let's get straight into it and talk about those rate cut calls. We have started to see an adjustment at the front end of the yield curve. 2-year yields pushing higher. How much of an adjustment do you think we need to see in the stock market?
Well, personally, I think for the stock market to become attractive, where the risk reward starts to flip and become really attractive, I think you've got to see somewhere in the neighborhood of 5 to 8% down from today's levels, right? And it's not unusual at all to get those 2 to 3, 8 to 10% corrections intra-year. So I think that's entirely possible. Remember, let me just spin you back for context here. This time last year, the consensus was 85% of economists said we were heading to a recession, and the Fed funds futures curve had 3 interest rate cuts priced in for the back half of 2023. We know those never happened, obviously. Here we sit today, the consensus is this: soft landing, 4 to 5 rate cuts, 10 to 12% earnings growth, and we've slayed the inflation beast. It's not a problem anymore, right? My bet is when we spin forward 12 months and look backwards, that consensus is wrong on a number of those accounts.
A repeat of last year?
I think a repeat in the sense of the Fed just can't give you what the markets want the Fed to give you, right? Which is what you know, if you describe this year to date, it's been pretty boring so far. I mean, the equity markets have drifted a little bit higher. VIX is still low. Gold has not been an issue. Oil prices have not been an issue. It's just been rates, right? We're repricing rates to back out some of those cuts. So I think you've got to see, for us in 2024, you've got to see 3 things happen. If inflation was all the rage in 23, this year it's the labor market, and that in the linchpin to consumer spending. It's earnings, which we need to probably talk about because they're not as good as what I think people think they are. And then it's what the Fed does. Those 3 things are what will determine the path for 2024.
Why not just buy NVIDIA?
Well, it's 30 to 35 times sales, right? Look, I mean, you're correct, and you're exactly right, Lisa, that it's narrowing. I pulled the numbers last night, right? We've had 6 of the 7 Mag 7 report, right? NVIDIA is the only one left here on February 21st. If you look at sales growth and earnings growth, the whole S&P is running about 4.5% sales growth and just under 2% earnings growth. If I take the Mag 7, 14% sales growth and their margins have expanded 750 basis points year over year on this quarter. If I look at the other 493 stocks, I'm getting a paltry 2% sales growth, and margins have contracted by 110 to 120 basis points. So underneath the surface, that durability of demand, hence the reason maybe this idea that breadth is not widening out, people are not finding the value there to widen it out.
So can you walk us through kind of how you see the calendar evolving? If you think people are getting it wrong, consensus is wrong, and we're talking about a soft landing and a Fed that's going to be cutting rates and inflation's going to be coming down, where does everybody have it wrong? Is it inflation coming down? Is it the Fed cutting rates? Or is it the degree of weakness that will hit suddenly?
If I were to stack rank that, I would say it's probably the Fed wrong, inflation next, and then the weakness after that, right? In that sequential order. The reality is, I think the consensus has moved so hard to just, we've won the war, we've won the battle. And yet if I look at, you all know that the yield curve remains deeply inverted, right? If I take the 6-month to 10-year, it's 110 basis points inverted. If I take leading economic indicators, which we used to pay attention to, we're 18 months in a row in negative territory, right? That just doesn't happen. In fact, it hasn't happened since 1951. If I look at ISM manufacturing, which, by the way, surprised by 2 points to the upside last week, but now is still 15 months into contraction territory below 50, right? And again, it's not to be bearish or negative per se, but it's to balance the conversation out here. I think the markets have gotten tipped a little too far to this kind of euphoria and optimism that everything is good and we've won all the wars.
What's happening with margins? Can we talk about that a little bit? Just got another headline crossing the Bloomberg. I can share it with you. DocuSign, more job cuts. 6% of the workforce set to go. Yesterday, Estee Lauder, 3 to 5% of the workforce. Lisa was talking about UPS in the last week. UPS, 14% of about 85,000 management jobs are getting cut. Are we in that period of the cycle, that phase of the cycle, where we're starting to try and protect margins, where we're starting to really attack costs?
Yeah, I mean, you see it in the corporate earnings reports. And believe it or not, what people miss on this is it's right on time. It is exactly on time from a historical standpoint. Now, you have to calibrate based off of how much liquidity is in the engine. But if you go back all the way to the 1950s and you take every period of economic slowdown, on average, labor weakens 23 months after the first Fed rate hike, okay? So 23 months from March of 2022 puts you where? February 23, right? You're just on pace right now to start seeing that weakness happen. So let's acknowledge blowout, non-farm payrolls report on Friday. We'll take it all day long. But I would be looking at the months coming forward, because I think you'll start to see the unemployment rate drift up. You'll start to see some of these corporate layoffs that are companies defending their margin line because they don't have the pricing power in the sales line anymore. And so they've got to make an earnings number, which is why we think 10 to 12% earnings growth for 2024 is just still too high.
Do I want to play the recovery to the downturn we haven't had yet? We asked that a lot in the last 12 months. Is it too early to get excited about things like small caps?
It's interesting. We were looking closely in our investment strategy committee the other day about small caps. So every year at the beginning of the year, people want to declare this is the year of small caps, right? It's happened for the last 5 or 6 years, and every year it's been wrong, right? Large have just pummeled small. We started to see a little bit of that turn in December, right? Now, all of a sudden, as of this morning, small caps are underperforming large caps year to date by 600 to 700 basis points. What is a little bit compelling there is the narrowness of where the S&P earnings multiples are at versus small cap multiples are as narrow as they've been in decades. Meaning small caps are cheap relative to large caps. Is that a function of large cap being too expensive at 22 times? Maybe, right? But small caps certainly have not had that same multiple expansion that large caps enjoyed in 23, 22. So there can be a compelling valuation case there. The problem with them is they're going to have to deal with that highly leveraged business model, right, with rates being higher, and that's going to chew into earnings growth.
Reminds me of what we used to hear about European stocks like 10 years ago. Compelling valuation case, but just wasn't working.
Which would have been wrong for the last 5 years, right?
Apart from the last 12 months where things have started to happen. Darryl, it's good to see you.
You too.
Darryl Cronk of Wells Fargo, brilliantly explained, just looking at earnings there, and what it means from corporate America to the stock market on the headline basis, as well as what's happening beneath the surface. Equity futures right now, just about turning positive in the last 5 or 10 minutes. We're up here by 0.05%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. U.S. Secretary of State Antony Blinken is on his 5th trip to the Middle East since Hamas's October 7th attack on Israel. Blinken will meet with Egypt's president before traveling to Doha. Negotiators from Egypt and Qatar are proposing a deal with Hamas to pause fighting and allow for the release of the remaining Israeli hostages. Israel would in turn release Palestinian prisoners. Blinken is also expected to make stops in Israel and the West Bank in the coming days. Oil giant BP is surging to a 2-month high after beating on fourth quarter earnings and announcing a faster timeline for share buybacks. The oil major says that it will repurchase $1.75 billion worth of stock in the first 2 quarters of this year. Exxon, Chevron, and Shell had also all beat expectations. Rental car company Hertz, on the other hand, sliding this morning. It beat on fourth quarter revenue, but posted higher than expected losses. The drop follows the company's decision to cut 20,000 Teslas, or about 1/3 of its EV fleet. Hertz says it lost money renting them out, and it's part of a larger trend of EV demand sliding and Tesla cutting prices on popular models. That's your Bloomberg Brief. John.
Danny, it's a reality check here in the United States on EVs. You've just come out of London. Is it any different in Europe?
John, you know what it is? It's the charging infrastructure. I myself have rented a Tesla from a rental car company. I can drive up and down the UK and have no problem finding one of those hyperspeed charging stations. It's about that. It's about prices, yes, I know, but also the infrastructure just isn't here.
Interesting, Danny. Appreciate it. Anne-Marie, it's so true. This conversation we're having in America at American auto manufacturers is so different to the European experience in the last 12 months.
Absolutely, also different culturally. Europeans are way more willing to get into trains, and they have better train infrastructure. They have smaller geographical distance to cover. The United States is just a driving community. That's what the U.S. does. And you'll even hear U.S. officials talk about it all the time. When they're concerned about trucks and driving, it's because even to get our groceries, it's farm to truck to table. Everything involves a car.
Hertz in a pre-market, down about 8% in early trading. Up next on the program, a border deal nearing collapse.
The only way to get things done is to work in a bipartisan way. The American people are smart. They're going to know exactly who to blame if this bill does not even get a hearing in the United States House of Representatives.
We'll get into that next on the program. Live from New York, this is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, equities here just about positive, turning positive by 0.1%, 1 hour, 13 minutes away from the opening bell. Under surveillance this morning, a border deal nearing collapse.
Ability of Congress to pass any kind of border security or immigration reform has been a point of great frustration. It's very self-defeating that we've been able to do it. The only way to get things done is to work in a bipartisan way. That's what this bill represents. The American people are smart. They're going to know exactly who to blame if this bill does not even get a hearing in the United States House of Representatives.
So here's the latest. GOP support crumbling for a deal to impose new U.S. border restrictions and unlock Ukraine aid. GOP frontrunner Donald Trump opposing the deal, saying it's, quote, a great gift to the Democrats and a death wish for the Republican Party. Bloomberg's Michael Shepard joins us now for more. Mike, let's get into it. Opinion in the Wall Street Journal from the editorial board. If Republicans reject this bill, they will hand Democrats an argument that the GOP wants border chaos that they can exploit as a campaign issue. If this bill doesn't go through, who wins the blame game?
Well, it's hard to say, and voters will get to decide that, John. It is so interesting to see how this plays out because there are so many other elements tied to it, including aid for Israel, aid to Ukraine, not to mention the really chaotic situation that we're seeing unfold on the border every day. For President Joe Biden, who's seeking re-election, and Democrats who are trying to preserve and maybe make some inroads, their gains in Congress and maybe make some inroads in the House, on one level, you could point to that they are Republicans, that is, that Republicans have failed to follow through on what they had actually wanted. They wanted a deal, a negotiation like this that would allow them to once and for all solve the border, and now they're backing away. On the other hand, though, the headlines in the polls do not favor Biden and Democrats. In our most recent Bloomberg Morning Consult poll, it was President Joe Biden who, among all politicians in Washington and elsewhere, drew the most blame among those surveyed.
Mike, if this continues to drag on, and it looks like it's going to, the Republicans want to drag these talks on when it comes to immigration. You mentioned aid to Israel and aid to Ukraine. Last night, the White House said the president would veto a standalone Israel bill. At some point, is he going to have to come around to that?
Well, that's a good question, and that is one that our teams have been asking. What about Ukraine? What about Israel? At what point will they have to break off those two elements of this big border package, which totals $118 billion? A big chunk of that, $60 billion, for example, would go to Ukraine. Now, for the president, the clock is ticking when it comes to Ukraine. On the border as well, what he has to do is he has to measure whether he has any kind of political leverage with Republicans right now. One question we've been asking is whether the president will meet with Mike Johnson anytime soon to try to reach some sort of a break in this growing impasse. And remember, Biden put in this request for the money back in October. This is not something that just showed up on the doorstep in January. This has been months of negotiations without really an endgame or progress in hand yet.
And who was responsible for linking them together? Because a lot of people are saying it's the president who linked the supplemental together. But wasn't it because he was goaded by Republicans who refused to give foreign aid money when there was no aid for the southern border?
Well, you're right, Anne-Marie. Republicans early on wanted to link them so that they would be able to argue, look, we are not going to take care of security abroad without handling security at home, at least at the same time, if not first. So the argument all along has been, let's try to pair them together as one larger security package internally for the U.S., but then externally for our allies, including Ukraine and Israel.
Shep, Nikki Haley's got a problem. We're not talking about her. We're talking about Biden. We're talking about Trump. We've not mentioned Nikki Haley once this morning. How does Nikki get a hearing ahead of these big votes in a few weeks to come?
Well, she may need to do more than just the one Saturday Night Live appearance that we saw over the weekend. It is really hard for her to break through, even in her home state of South Carolina. Trump is polling well ahead of her there consistently. It's not that she is rejected as someone from South Carolina, somebody from the Palmetto State. It is just that voters there, it's an evangelical Christian stronghold. It's very conservative, and those people liked Trump as their president so many years ago, and they want more of that again, and they are kind of rejecting Nikki Haley for that role, let's just say. It will be hard for her to break through. They are advertising heavily in the 7 major markets that composed South Carolina, 7 major media markets. We've spoken, our reporters have been in touch with her team about their plans when it comes to advertising and fundraising. And look, she has been raising funds from business interests, from people on Wall Street who very much would like to see her as the alternative on the Republican ticket to Donald Trump.
Wall Street wants to see her, but Republicans in Congress don't. Shep, I wrote a story last night. 19 senators, 98 House members will be showing up to a Trump fundraiser next month. Does she have any support from her party in Washington?
It is very narrow. It doesn't come anywhere close to the enthusiasm and support that Trump gets. And we just opened our conversation talking about the border deal. Trump's role in that cannot be overstated. He is really pushing the agenda, driving the conversation already. And he has picked up a lot of those endorsements a lot earlier than he did in 2016.
Hey, Shep, thanks for the update. Michael Shepard there of Bloomberg down in Washington, D.C. Got to go back over it. Bramo, we are not talking about Nikki Haley. She is not getting a hearing in this at all. We're talking about the sitting president for obvious reasons, the former president orchestrating what's happening down in Congress with this bill. Nikki Haley doesn't even feature. Do you even know what Nikki Haley's thoughts are on this bill that's trying to go through Congress? I don't. Does anyone?
No, I think it's a good point. I did, though, see the story yesterday about her asking for more Secret Service protection. And you just wonder how much animosity there is to anyone who is not Trump. And the fact that she's sort of that character that she is having to play at a time where she definitely is not going to really win, but seems to be trying to stay in the race.
Over the weekend, when she was on CNN, she spoke to the fact that she did think what Trump was doing when it came to the border and breathing down those Republicans who, when I wrote last night, a lot of them support him and they're all going to be showing up to his fundraiser next month. She said that this is very political, and she called him out for being too political. Similar rhetoric we heard from the White House last night.
Who gets the blame? Let's go back to that Wall Street Journal editorial. Who gets the blame, and does the electorate see right through it? Is this really about substance or about maintaining, preserving an issue to campaign on in the election? If Republicans, quote, reject this bill, they will hand Democrats an argument that the GOP wants border chaos that they can exploit as a campaign issue. Do they see through it or not? You look at the polls right now, it's clear. The electorate right now blames the sitting president. They don't blame Republicans. Is that really going to change if this bill fails?
Not to think out loud here, but how much does this really depend on whether the Democrats can come up with a cohesive message where they celebrate some sort of victory with a bill, or say on the flip side, we need something done and Republicans were the ones to stymie it? Because right now you have on the progressive side people pushing against the Democrats. I mean, the sort of fissures within their own party are making the message kind of cloudy.
The Wall Street Journal also talks about in that same op-ed, Republicans may think they can write a better law if Trump wins in November, but don't count on it. Democrats are going to now demand more if Republicans don't show up now, and they may end up getting a watered-down bill. So the substance might become even more complicated for Republicans. This may be their best shot.
Interesting. Coming up next on the program, Lara Raim of FS Investments on her call for surgical rate cuts. That conversation just around the corner. Equity futures on the S&P 500, positive here by 0.1%. In the bond market, yields look like this, just a little bit lower by a single basis point, 4.14 on a 10-year, on a 2-year down 2 basis points, 4.45. 1 hour and 4 minutes away from the opening bell from New York. This is Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Lisa, in the commercial break, an official review of Goldilocks the fairy tale. What did you say? Goldilocks is a brat?
I thought we were going to keep this in the break.
Okay, no, I just think people need to know how entertaining you are in the commercial break.
Your bedtime stories to the kids must be.
Like the people that adore Bramo already, you would love her so much more if we had a live cam in the commercial break.
I just think that Goldilocks is kind of a brat. She steals their food. She sleeps in her bed. Let's move on.
Is this criticism of the fairy tale or people on Wall Street who are looking for a soft landing, that Goldilocks inflation growth mix?
I was really just talking about the fairy tale.
Okay,
but
just
you
breaking
could make
things
that
down.
analogy,
All right,
but
good.
somebody else can do that, not me.
Let's turn to financial markets. We'll move on. Equities on the S&P, positive here by 0.1%, up by 0.2% on the Nasdaq 100. Just a little bit firmer here, higher going into the open, about 60 minutes away. In the bond market, a reassessment of yields in the last couple of days, repricing them higher. This morning, a little bit lower, down 2 basis points, 4.4515 on a 2-year, on a 10-year, down a single basis point, 4.1462. And just to finish off on foreign exchange, the euro negative by, let's call it 0.1%, 107.31. You mentioned Steve Englander of Standard Chartered, just talking about why this dollar strength is persisting. HSBC on the same page.
Saying the bar is pretty high now for there to be some sort of shift on the Federal Reserve. And if they are going to prolong the rate cutting cycle, well, it kind of speaks to that divergence people were talking about earlier with the ECB maybe cutting first.
You need offsetting data to accumulate, according to the likes of Steve Englander at Standard Chartered. And right now, the data is accumulating in the other direction. Where are we on the surprise index now? Just a series of positive surprises in America, just relative to where expectations were.
It's actually the most positive that it's been going back to November. And it's going in the wrong direction. And that's part of the problem, is that people are saying, we expect a deceleration, and they've been wrong. And they've had to upgrade once again, which brings us back to the same story we were talking about
like
last
12 months ago.
Exactly.
Yes, it's amazing. It's amazing.
Just shocking.
On repeat. Under surveillance this morning, here's some top stories for you. Number one, bets growing. The Chinese government will backstop the country's stock rout. President Xi Jinping expected to meet with regulators as soon as today to discuss options, with nearly $7 trillion being wiped out of equities in Hong Kong and China since 2021. The news lifting China's benchmark index to its best day since 2022. Foreign inflows also surging, adding $1.7 billion today, the most this year. We've heard plenty of talk. Time to see action now, isn't it?
Or is it? We heard from Damian Sassower that it's an uninvestable market, but it's a tradable market. So you trade this, and then you get out before the reality sits in. I mean, how much is that really what we're seeing in the market? Because there would have to be such a package unveiled to create some sort of sustainable rally that essentially people are just like, oh, we can buy the news.
What's the quote that's attributed to the great investor Mike Platt of Bluecrest? He said something like, an investment is a trade gone wrong, or something like that. Do you remember that?
That's brilliant. I didn't know
line.
that. That's fantastic.
An investment is a trade gone wrong. There's plenty of investments that were trades that have gone wrong. Let's move stories. The US striking 2 more Houthi sea drones in Yemen as the militant group's Red Sea attacks continue. Military officials saying they determined the explosive devices to be a, quote, imminent threat to US Navy ships and merchant vessels. These strikes coming after Houthi rebels claimed responsibility for 2 more Red Sea ship attacks. Anne-Marie, these attacks continue.
They do continue, and the shipping industry is warning for anyone to be careful about the collateral damage if you're going to go through the Red Sea or the Gulf of Aden. So what this does show is that even though the U.S. has retaliated and deterred and degraded some of the Houthi capability, it hasn't stopped them, which is what the president actually said.
What was different about the strikes that took place Friday evening? Did you notice almost immediately after the market close, which you'd have to sense was deliberate? It was like 4 p.m. headlines start dropping. What was different about that than what we've seen over the last few weeks, the last month?
Well, when you're going after the Houthis, they're trying to degrade the missiles that they're firing into these vessels. The strike that we saw on Friday was in response to those 3 service members that were killed, and that was to these facilities that Iranian-backed proxies use in Syria and in Iraq. And what we've heard from the administration is it's not going to be an open-ended military campaign, but they also said it's going to be sustained, meaning we will see some more.
I'm just focused on the internet traffic. I mean, I'm serious because Norman Rule was talking about this yesterday. And then the Houthis put out on their Telegram channel a map and pictures of the internet cables, and they account for about 17% of the global internet traffic. I'm really trying to do a deep dive into these internet cables.
Literally. They have the willingness, do they have the ability?
Yeah, that's a good question.
Do they have the ability?
It's a good question, but I think it's something the U.S. is definitely concerned with, especially those cables that are under Egypt, which also Egypt gets paid a lot of money for.
That's the latest on that front. Here's the latest over on the West Coast in California. Powerful storm that's battered Southern California has caused $11 billion in damage and economic losses so far. AccuWeather making the calculation after more than 10 inches of rainfall fell in the mountains west of Los Angeles over a period of 2 days. The storm has killed 2 people and left major cities in the region at risk of flooding and landslides. There's talk of landslides in the Hollywood Hills.
Honestly, it's just such a tragedy to watch people's homes get blown out, and we'll have to assess it. I mean, it raises some questions about ensuring areas that have been prone to some of these mudslides for quite a while, but we'll just have to keep track and hope that they stay safe.
Third wettest day for February in data since 1877.
Wow.
And almost 1 million customers do not have electricity. So this is going to be a really big problem, and it's really scary.
That's the latest on that front. Any more information, we'll share it with you. We are about 55 minutes away from the opening bell. Equity futures on the S&P 500 positive by close to 0.1%. Yields pulling back from the 2024 highs we had a little look at yesterday. We're down 2 basis points on a 2-year at 445. Chicago Fed President Austin Goolsbee telling Bloomberg's Michael McKee he's not willing to rule out a March rate cut. Later today, we'll hear from the Fed's Mester, Kashkari, Collins, Harker, all of them still to come. Lara Raim, chief U.S. economist at FF Investments, saying this: it is incredible how long it has taken the market to let go of hopes for a March rate cut. My expectation is that we get 2 to 3 rate cuts in the second half of this year. Lara's calling them surgical rate cuts. Lara, I'm pleased to say, joins us now for more. Let's get into what's happening in this bond market, Lara. We've had a big reassessment of what is happening with the Federal Reserve, and yields have climbed on a 2-year, on a 10-year over the last 2 sessions by double digits. Are you surprised by how little we've moved? Do you expect us to move even more based on the data we've had so far?
Yeah, you know, I think it's been a reassessment, but given that we were at 5% as recently as October, I think there's room to have even more of a reassessment. I think this idea that we're sort of, you know, just pushing rate cuts out month by month by month, to me begs the question of how we're really stepping back and reevaluating as investors the impact of a higher yield world. And, you know, you add up the sheer supply of Treasury coming online. We're going to be able to get those auctions done, but all else equal, that's higher yield. The inflation genie is not fitting back in the bottle. That's a higher yield story. And then the growth. At the end of the day, I'm actually surprised yields aren't higher than they are.
Lara, with that in mind, why do you think it's better to express the stronger data through the bond market at the longer end of the curve and not necessarily at the front end?
Well, I think the inversion and the fact that short-term yields are so much higher than long-term yields is really still a signal that the bond market is nervous about some coming slowdown. Or it's also muscle memory from the fact that when we do have problems, the Fed slams rates down to 0. I think the Fed is in a place, maybe a good place, it hasn't been in for a long time. If the economy slows more than sort of a Goldilocks landing, and I agree with Lisa, that phrase is feeling overused at this point, the Fed has room to cut rates maybe a little bit more. But these 6 rate cut forecasts, to me, it need to come with some more significant economic slowdown, which wouldn't be great for equities.
Laura, you were talking about higher yields ahead, particularly in the long end. How much higher could you foresee at a time where a lot of people think we're kind of range bound for the foreseeable future?
You look at long tracts of history when nominal GDP aligned pretty closely with long-term yields. I don't want to make some insane forecast of yields going up above 6%, but you look at where we're growing today and say we settle around 5% nominal GDP growth. I don't think it's out of the question 5% on the 10-year at some point this year. And I just don't think markets are prepared for that. The complacency that we're seeing is coming from 2 places. It's coming from expectations that growth is just going to be very optimistic and that inflation is going to come down. But it's also coming from complacency that yields are going to stay low. Long-term yields are going to stay low. And I just think we need to prepare ourselves for a lot of yield volatility. We saw that last year. I think that carries forward.
One of the big things that people have been struggling with is what is the neutral rate, right? Because if it is much higher, rates could stay at that level for longer and you could see things kind of chug along. Do you have a sense of whether 5% 10-year yields would be incredibly restrictive? Are 4% yields restrictive? When do we know?
This is something that I have debated heavily because to a large degree, we can't measure the neutral rate. And if you look back at history, we've never actually sat at a neutral rate for any length of time. The Fed's always in very restrictive territory or always in accommodative territory. We don't tend to just hang out around 2.5% to 3.5% Fed funds rate. So I think, every Fed cycle starts because we've had a shock, either, a very strong growth shock or a very weak shock. And today we're still carrying the momentum from a very strong shock. So I think it could be another 6 quarters before we really get a sense of where we are. And in the meantime, wage pressure, inflation pressure, it's all creeping higher again.
So Lara, last year, I remember our conversation, you said inflation may not make the last mile. That's what you said last year. Here we are, you still seem to believe that's the case. We could sense with Chairman Powell in the news conference last week, he wasn't quite comfortable to say on behalf of the whole committee that they had greater confidence that we were indeed heading back towards 2% and they want to see more data. More of the same, perhaps. Not better, just more good data. He was concerned that perhaps the improvement we've seen over the last 6 months might have been down to one-off factors. Not his base case, but the concern exists. Clear to me that you may think it is actually down to one-off factors. What is it about the last 6 months that you see not repeatable in the next 6 months?
Getting from 6% to 3%, I think has been a lot easier. I've been sort of using that analogy of like a long road trip with a bunch of kids in the back of the car. If a couple of them start acting up, it makes the whole trip really difficult. And I think we're starting to see them act up again. And we've just, I think, had a nice period where, a short period where we were seeing, the energy, the goods prices, and progress on services moving together, but services is starting to creep higher. I think goods deflation may have run its course, and I think energy is very open to geopolitical risk. There are growing, I think, influences that are going to cause a couple of the kids to throw tantrums in the next 6 months of the journey.
Who are the kids in the back of the car? Name them. Fed officials, a handful of them? Or is this market participants?
I think the kids are what's driving inflation higher. It's, the shipping costs creeping higher. It's services wages creeping higher. It's coming from the fact that food prices are still, I think, too high for consumer comfort. It's coming from a lot of places now.
Lara Raim, thank you. Lara of FS Investments. That was brilliant, Bramo.
Okay, so the Fed is the McDonald's that you stop at to try to feed the kids,
to
try to deal with the issue that is sort of making everyone angsty, but then it's not going to really work because the underlying issues are
Chairman
real.
Powell is Ronald McDonald. Is this going into the newsletter?
I don't know.
This is so going into the
anyway,
newsletter,
but these are
All right.
it's actually a really good analogy. I'm going to play with this one.
I'm going to go back over this interview after we get off air. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Treasury Secretary Janet Yellen is set to testify on Capitol Hill this week. Yellen will speak before the House Financial Services Committee today and the Senate Banking Committee on Thursday. Lawmakers are expected to grill Yellen on the state of the economy and the fight against inflation. According to her prepared remarks, Yellen will discuss the potential for tougher regulations for asset managers and hedge funds. DocuSign, the latest tech firm to announce layoffs. The company will reduce staff by 6%, with the majority of the cuts coming from sales and marketing. According to layoffs.fyi, at least 32,000 tech workers have lost their job to start the year. Cuts have come from the likes of Snap, Amazon, Salesforce, and Meta. Users of Apple's Vision Pro are discovering the pain of losing their passcode. The company is telling users they'll have to bring their devices back into the store or mail it to AppleCare customer support if the device is disabled after entering the passcode incorrectly too many times. The Vision Pro went on sale on Friday and is Apple's first major new hardware category in almost a decade. That's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. Up next on the program, Big Oil delivering upbeat earnings.
It was a year of records for us. We had record global oil and gas production of 3.1 million barrels a day. So really strong performance in our business across the board allowed us to return a record $26 billion to shareholders, almost 10% of our market cap.
That's coming up next, live from New York City this morning. Good morning to you all. Counting you down to the opening bell, 46 minutes away, with equity futures on the S&P 500 positive here by 0.1%. A beautiful New York City. You're watching Bloomberg TV.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Live from New York City this morning. Good morning. Counting you down to the opening bell. We are about 43, 44 minutes away. Equities are doing okay, up by 0.1% on the S&P 500. Are getting pushed around in the last 24 hours or so by this bond market. Yields up aggressively yesterday, like they were on Friday, but equities were down off the back of that. So make sense of all of that if you can. Maybe Meta, Amazon to thank for things on Friday, and they just weren't present in the same way on Monday. In the bond market, 10-year yields 4.1578 on a US 10-year. Under surveillance this morning, Big Oil delivering upbeat earnings.
It was a year of records for us. We had record global oil and gas production of 3.1 million barrels a day, record U.S. production, and in the fourth quarter, we had record Permian production of over 870,000 barrels per day. So really strong performance in our business across the board allowed us to return a record $26 billion to shareholders, almost 10% of our market cap.
Just amazing. Here's the latest this morning. Oil's biggest players delivering exactly what they promised investors, growth and returns. BP joining the ranks of Chevron and Exxon, beating estimates and announcing an accelerated buyback plan. Javier Blas of Bloomberg Opinion joins us now for more. Javier, new column, BP, Exxon, all of the above, your title, your headline, Big Oil's boring quarter, golden for investors. Javier, can you frame just how big these capital returns have been?
Well, last year, Chevron, Exxon, and Shell returned $80 billion to shareholders between dividends and buybacks. It's an extraordinary amount of money. And what is really good is that in the last couple of quarters, these three companies, now BP has also joined, are becoming a bit of a boring. There is nothing flashy on their earnings. It's just good delivery, a lot of cash, exactly what investors need to reconnect with the sector. Just give them the cash that they need.
So that's how they reconnect. How much do they need some higher oil prices to reconnect as well, given the fact that that's been one of the biggest surprises, is the fact that oil just hasn't rallied in the face of a lot of potential pressures?
Well, that was a big question last year because a lot of investors say, yes, these companies are doing very well, but look, it's the background, is the invasion of Ukraine, is the situation in the Middle East. Now we don't have any of that. Oil has been trading below $100 for many months. Natural gas prices are no longer at record highs here in Europe. Refining margins have come down to the ground. They are still elevated by historical standards, but they are not those record highs of last year. And still, big oil is performing. I think that one of the things that is very good is that companies are reining on capex, and they are also starting to reduce operational expenditures. They are making their balance sheet a lot stronger, and therefore they can perform in environments of oil prices which is still elevated, $75, $80 a barrel, but nothing like the $100 plus of the last couple of years.
That's a fascinating point, Javier, which raises this question: how much can these shares rally just to catch up with valuations elsewhere on the basis of dividends and, as you put it, financial acumen, regardless of the price of oil?
Well, that's a very important point. Probably we are seeing in terms of valuation as good as it gets. I mean, the big oil is not going to go back to the 90s and 2000 when investors really love it. It's going to be a sector that many investors will not touch, no matter how much money they are returning, and therefore the valuations are going to be always under challenge. But it has recovered, and you know, there is now a sector that if you are an investor and look the return that they are offering, the yield that they are offering is a sector that every investor needs to consider.
I feel like I was living the upside down world, Javier, last week when you have Exxon and Chevron talking about ramping up in the Permian, but Saudi Arabia deciding to ditch plans they've had to expand spare capacity. Do you see the U.S. becoming a bright spot that becomes even brighter?
I think that it's going to remain brighter. I see more production coming from the United States. I will expect that the pace of growth in U.S. oil production is going to slow down from last year. But also, I said that last year and I got it wrong, that the pace barely slowed down. I think even more interestingly, we are going to have more production growth probably coming from Canada this year, at the same time that we see more production coming from Brazil and from Guyana. It's just the whole of the American continent, a big bright spot for oil production, and then obviously the Saudis are challenged.
We have hostilities once again overnight in the Red Sea, Javier, but oil fails to break out. How much lower do you think prices would be if we stripped out all the volatility we've been seeing over the past few months?
I don't think that the Middle East has been a big factor right now on the valuation of oil prices. The market is at the moment completely ignored the geopolitical risk, and I don't think that there is much of a geopolitical risk applied right now to oil. So if everything is stopped in the Middle East right now, I don't see much of a downside for the market. Can we go $2 or $3 lower? Yes, but I think that the price at the moment is being driven by the fundamentals of supply and demand. And let's not forget, the demand continues to look relatively good. I mean, yes, you know, China is challenging, but all consider oil demand growth in 2024, 1 million, 1.2 million, 1.3 million barrels a day is a pretty good result for all what is happening in the world.
Begs the question, Javier, why crude isn't higher then? So maybe we can finish there. Where does this comfort come from? Why are we able to ignore what's been developing in the Middle East for the last 3 4 months. You remember what happened in 2019 when Houthi militants were able to take out a big chunk of Saudi production. We're not seeing that play out in quite the same way this time around. But why do you think we are so comfortable with what's been playing out just in terms of crude prices?
Perhaps complacency, because yes, the Houthis were able to knock down a lot of Saudi capacity for a few days, but then that production came remarkably quick to the market. So the market is effectively reassured. It has never happened, so the market just gets complacent. There is a lot of spare capacity in the Middle East, in the United Arab Emirates and Saudi Arabia. And at the same time, there is still a lot of production coming from the United States and Canada and Guyana and Brazil, and the market sees those barrels coming, and probably non-OPEC production is going to be more than enough in 2024 to meet all the incremental oil demand.
Brent crude right now 78.53, WTI 73.32. Javier, great to catch up. We should do this much more often, sir. Javier Blaster of Bloomberg Opinion out of London today. Crude is positive by 0.7%, 78.53. WTI up 0.75% on crude right now, 73.31. We're about 40 minutes away from the opening bell. Lisa, lessons of this morning, takeaways. Your takeaway is Goldilocks is on life support.
That's my takeaway, although I will say that I'm sure that I'm going to get a lot of hate mail from people who love Goldilocks and don't think that she's a brat. I do think, though, that there is a question of whether we're talking about no landing again and what that looks like. How much this talks about the potential for a hard landing later on, how much we're talking about just a higher neutral rate going forward. These are some of the debates that I think are the most heated right now.
Yeah, I go back to Dan Morris of BNP Paribas in the last couple of hours, who said Goldilocks is just a fairy tale. Laura Raymer of FS Investments in the last 20 minutes suggesting that rates need to go higher, not at the front end, but further out along the curve, which I think folds into what we heard from Matt Lazzetti at Deutsche Bank, who suggested that maybe that neutral nominal rate is closer to 4 than it is to 3.
Are we restrictive? Because right now we're seeing really strong growth. If it continues and we're not restrictive, that means that it's sustainable to have a 5% Fed funds rate and still see growth. Maybe it's a 4% Fed funds rate. Either way, it's a far cry from 0%.
So let's finish the show exactly where we started. If Goldilocks is on life support, is that bill going through Congress dead on arrival? Everyone wants to say it is. Politico in the article this morning, what was the title of their note this morning? Everything's dead. Is everything dead?
Well, I don't know. You have to look at also past bills and how long they took to get through. The bipartisan hard infrastructure took months to get through. Biden talked about that when he first came into office. It got through in November of 2021. The problem is the election is in November. The closer we get to the election, how hard is it going to be for Republicans to sign up for this bill? But to the Wall Street Journal's point this morning, their editorial board, if the Republicans don't do anything, the electorate is going to smarten up and say, it's not just Donald Trump that wants to make this an election issue, and they're gonna actually start to blame the Republicans for this.
For the time being, is it convenient for both parties to drag this out, to leave this bill and just fight over it for the next couple of weeks?
I do not think it's convenient for the Democrats. Biden is the incumbent president. Immigration is becoming a much more important issue. If you look at our polling, the economy's people are starting to feel a little bit better about the economy, so they're starting to rank immigration as higher.
Yeah.
65 and over, the economy and immigration neck and neck as top issues.
Quickly becoming the biggest story in this country. Coming up tomorrow, don't miss this lineup, stacked lineup for you. Tony Dwyer of Canaccord Genuity, Jane Foley of Rabobank, Block co-founder Jim McKelvey, and Michael Nathanson of MoffettNathanson. All of that and a whole lot more from New York City this morning. Good morning. With about 34 minutes away until the opening bell, equity futures positive by 0.1%. From New York, this was Bloomberg Surveillance.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is that we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrell. There's a sheer defiance in these equity markets. Despite a 27 basis point ratchet higher in the bond markets, equities are defiant. Countdown to the open. It begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrell.
Coming up in the show, investors brace for the next wave of Fed speak. Senate Republicans jeopardizing the latest U.S. border agreement, and DocuSign adds to the growing list of tech companies slashing jobs. We begin with the only issue, the big issue, the Fed staying on message.
If we keep getting strong quantity numbers, that is to say jobs numbers, GDP numbers, growth numbers, while inflation goes down, in the conventional view, that's not really supposed to happen. So that we'd have to be entertaining the possibility that we're entering a period like the mid to late 90s where you had productivity growth faster than expected, faster than trend, and that opens up some new possibilities.
Traders walking back the hopes of a March rate cut, bracing for the next round of Fed officials to speak and continuing to push back. Is that the narrative? Mike McKee joins me now on set. Mike, what do you think we get? We've got a raft of speech today.
Well, it's kind of interesting, Manus, because yesterday Austin Goolsbee was a little bit nebulous about whether they should cut in March or not. He wouldn't endorse the chairman's talk. And here's why we're looking at this issue. As you can see, job growth going up, inflation going down. It is, as Goolsbee said, a kind of remarkable situation, and that does leave them perhaps options. But it also raises questions. If job growth is going back up, where are we going to end up? Neil Kashkari, the Minneapolis Fed president, published an essay yesterday suggesting that it might be on the other side. Bad news. The constellation of data suggests to me the current stance of monetary policy may not be as tight as we would have assumed. And yesterday, we got the Senior Loan Officer Survey for the fourth quarter from the Federal Reserve, and here's what it showed. It showed fewer banks are tightening credit standards, particularly those who are tightening them just a little bit, and it showed loan demand starting to significantly rise. So, are we seeing a slightly stronger economy that would give the Fed pause in March and maybe even May? Well, yesterday we had the odds of a March rate move, rather, at about 15%. Today they're up to 20%. Some people just not letting go yet. Ahead of all this Fed speak, we'll see who lines up on what side.
Indeed. Let's see who kills off March and pushes May further into the long grass. Michael, thank you very much. Michael McKee, setting the agenda on FedSpeak for the day. Let's have that conversation. Monica Defend joins me from Amundi Institute and Morgan Stanley's Dan Skelly. Here we are. We've had hellish velocity in this bond market for the past 2 days. 27 basis points, the biggest move since June 2022. Dan, let me bring it to you first of all. A healthy repricing?
Yeah, we think it is. And frankly, the market was overly optimistic and over its skis related to Fed cuts. I mean, you were basically expecting a 100% chance on Jan 1 of March. Then that was a coin toss a few weeks ago. And now it's where it should be, which is a much lower probability based on the strong economic data as manifested in jobs and ISM new orders over the last week or so. So look, I think the reality is the market is moving towards near certainty, 100% of the middle of this year for Fed cuts, which is frankly where Ellen Zentner has been all along.
Monica, good morning. How are you? I mean, they've got every reason under the sun. They've got a good jobs report. They've got Powell pushing back. They've got inflation behaving. They've got a strong economy. Good news, you're up 27 basis points. What does that mean to you?
Again, to me, it's just a repricing with the market that overshoot in terms of expectation of cuts to be next door. And it confirms our view that the cuts will come later. Later for us means May, and then we can debate on the size of the cuts to come. But definitely, as an economist, is a moment where we're having big headaches. As investors, we're just noticing that valuations today matters more than the economic backdrop.
Here's the conundrum, isn't it? It's about debating, as Kashkari does, where the higher neutral rate is. But to both of you, I would ask you the question. Dan, you say at the heart is of the interest rate cycle. It's going to be higher than the last one, higher neutral case. I mean, what does that mean, living in a higher for longer? I don't think that this equity market, nor the bond market, has really coalesced around a higher for longer new normal. What does that higher for longer new normal mean, Dan? If Goolsby's right, and we're going back to the 1990s, that takes me to 5 bid at 6 in rates.
Well, listen, I think higher for longer is, frankly, a good thing in terms of rewarding economic prudence and efficiencies. When you think about the 08 to 20 cycle, we were in a very abnormal period, as we all know, in terms of zero rates and really very little investment on the part of the government, on the part of companies. Companies, as we recall, were doing financial engineering and buying back stock or doing other types of financial measures. They were not investing for growth. And today you're seeing, like you mentioned, a very different environment. Despite growth potentially slowing throughout this year and rates being cut throughout this year, the way we've said it is the resting heart rate for growth and real cost of capital is higher than that 08 to 20 period. And importantly, at the same time, you're seeing an investment cycle from the fiscal spending initiatives from the government reindustrializing the U.S., from companies investing in AI. And so there's a massive innovation cycle going on. So what does that mean? That means two things. First, you simply have to focus on those companies that have stronger balance sheets, higher quality free cash flows, wider moats. And you want to focus on the companies that are either benefiting from this.
That higher new normal, and this is what we need to try and grapple with. We're baying as a market for 5 to 6 rate cuts of 25 bips each. The market has accelerated in terms of risk. The question is whether risk is just too infused by this scale of rate cuts, and what is the new normal? I mean, is it 100 basis points lower from here in a no landing scenario?
So our official case is for a soft landing this year, which is where Ellen has been for the last 2 years. And we're also seeing about 3 cuts this year as well, starting in June. And so, look, it is that kind of disinflationary growth scenario. Now, the equity market, I'll just come back to the equity market, is narrowing, right? Even the Magnificent Seven The leadership group of last year has become the Fab Four more recently, and you're seeing a lot more concentration in quality growth at a reasonable price, right? So we are seeing some narrowing inside the Magnificent Seven itself based on fundamentals, based on relative earnings revisions and fundamental economic updates. But we're also seeing other winning sectors and themes as well.
Monica, again, I look at the credit spreads. They are so tight. Equities are just defiant in the face of the velocity of rates. How well behaved do you think credit is going to be? By the way, Snap are cutting jobs, tech are cutting jobs, big tech are cutting jobs. There are canaries plopping into the bottom of the cage as we speak. But with that in mind, credit remains unabashed and resilient.
Yeah, I agree. But, you know, higher for longer doesn't mean higher forever. It is true that the credit market actually has not been hit that much by higher rate. If you look at the ISM on services, actually, it looks like companies have not been hit by higher rates. If I look at profit generation, again, all positive, but the LIBOR. So it means that moving forward, we do expect these financial conditions to tighten a bit. And for example, when compared to consensus, our EPS projections are much lower. We are into the 6%, which is placing on historical averages, I would say. Having said that, on the investment grade, this is what we recommend. Stay on the quality side, just because we see some pronounced slowdown kicking in the second, third quarter of this year, and something has to give eventually.
Do you, Monica, I'm actually going to lean into your European exposure and perhaps depth, that differential between the US and Europe, when you look at the credit cycle between the two, will there be more resilience in the US relative to the European narrative?
For the time being, we still prefer the European IG versus the US, but it was really based on the idea that the US slowdown would have been now, which is not the case eventually.
No, it's not. Dan,
Definitely not.
No, well, let's see what the ECB actually does and how this plays out. I have a guest coming up who says that he just doesn't believe the data and he should be pounding the table, but more of that in a moment. Dan, 2024, you expect the market to go from a right tail surprise to a wider middle, and this means a higher chance of more normal 6-7% equity return, with potential upside coming from quality active portfolios. Now, 6-7% is a more normalized return. Is that broad-based? Are you prepared to go for breadth to deliver the 6-7% equity return?
Yeah, and so the genesis of the wider normal is simply a function of last year's right tail surprises in terms of massive fiscal upside, the consumer still spending red hot. We don't think some of those red hot surprises are going to exist as much this year. And the other thing I would argue is, frankly, starting points matter, as our team has talked about quite a bit. We're at 20 times forward earnings. We know that Powell's going to be cutting at some point. Maybe it's not March, as we've discussed. Maybe it's closer to the middle of this year, as the market is 100% certain of. And so there's a lot of good news now in the price. So listen, the 6-7% return is just a function of earnings growth, right? If we can just hold our multiple at 20 and grow something like mid-single digits this year, that's the index return. As I referenced, we think you can get active management returns in excess of that. Where are you going to see some of the upside surprise? We think it's still in some of the tech and select software enablers of productivity, right? Be more selective than last year, of course, given the starting point. But importantly, we also want to be positioned in some of the beneficiaries of tech diffusion and the users of AI. Where are we seeing those gains? Healthcare, industrials, and in select consumer business models.
Monica, if I just return to you in terms of your outlook. The debate, we've just had Dan lay out their roadmap for rate cuts. We touched on Europe. The risk is this, is that Europe outpunches the Fed in terms of size and timing of the rate cuts. Is that a built-in consensus now in the FX and in the equity and credit story? Is that already imbued in the prices in Europe?
Not necessarily, meaning that in Europe, the bargaining on wages is still on, and it will be like this until end of March, early April. So this is why we don't think it would be appropriate for the ECB to act by then. Then still, the economic situation in the euro area is much different from the US, more flattish growth with some surprises to downside when it goes to Germany, and on the upside from the periphery. So we have this call for June when it goes to the ECB to start cutting. But I think really the rationale is different, and the timing is not necessarily one to the other related.
Dan, let's just finish off. We've got Snapchat cutting 8, 9, 10% of the workforce yesterday. DocuSign's cutting 6% of their workforce. Defending margins in tech in the Mag 7. I know you say it turns into the Fab 4. But are we going to see more of this incremental job cutting to defend margin in tech?
Well, for the big platform, the biggest names, right, they went through their down cycle in labor 1.5 years, 2 years ago. And a couple of things have happened as a function of that. Part one is, I think a lot of those workers who were maybe the 8th best engineer at a big tech company have now become fairly valuable or productive at a healthcare company or at a government agency, et cetera. There's so much demand for tech skills across the economy that I think those folks are becoming reabsorbed into the economy very quickly. Part two is when you think about what happened to the cost structures and the business models, you're seeing operating leverage. All right, so you're seeing a recovery in corporate IT spending and cloud and some of these other tools, AI, of course, but you're seeing a recovery across the board. And so on a lower cost base, those big platforms are now seeing some operating leverage. And you saw that manifested in some of the earnings results last week. So listen, I don't think that some of the smaller companies in terms of the aggregate matter that much. I think you really want to focus on the bigger companies.
Okay. Let's see how the rest of this earnings season falls out. Monica Defan, Dan Skelly on the markets. Joining us now to look under the hood, stocks moving ahead of the bell. It's Abigail Doolittle.
Well, Manus, we do have a relatively flat surface for the futures, but beneath that surface, we do have some bigger movers to the downside. Tesla, these shares are down almost 2%. Actually, they're off the lows, down 1.4%. SAP has stopped offering Teslas as company cars to employees, similar to rental companies Hertz and Sixt. They've also pulled Tesla from their fleets. One reason being given are the price fluctuations. Eli Lilly, on the other hand, up 5.4%. They put up a 14% adjusted earnings beat, 4% sales beat. Their new weight loss drug, Zepbound, launched in December, brought in $176 million in that very short period. The 2020 forecast, not surprisingly, is better. And then finally, Palantir surging up 21%. The data company posted its first annual profit. They also gave a higher profit outlook. AI, the big driver. There's only a 5% short interest there, so there's a little bit of a squeeze, but not so much. It seems like there's some real buying power there, Manus.
Yeah, and that's what we're seeing, the switch in the jobs from perhaps some cuts into the recruiting in the AI space. Abby, thank you very much. It's about rebalancing the human capital element within tech. Coming up in the show, President making his pitch to Congress.
My next Speaker Johnson is pay attention to what the Senate's doing. Everything in that bipartisan bill gives me control, gives us control, without being, and still meets the needs of the people being able to legally come across.
The latest developments on Capitol Hill. That's next on Bloomberg.
the reception, the acceptance of Purosang has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosang all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
My next Speaker Johnson is pay attention to what the Senate's doing. We got a bipartisan deal, so you're going to see the detail of it this week. Everything in that bipartisan bill gives me control, gives us control, without being, and still meets the needs of the people being able to legally come across. We want to open avenues of legality and shut down the ones that are not coming through the points of entry.
President Joe Biden trying to drum up support for the bipartisan Senate deal would impose new U.S. border restrictions, provide billions of dollars in aid to Ukraine. Now, the House Speaker Mike Johnson had this to say, and other GOP leaders giving the deal a thumbs down. The Speaker said they warned that a compromise deal was dead on arrival. Former President Trump saying a great gift for Democrats and a death wish for the Republican Party. So it is the long arm of Donald Trump, the former U.S. president. Joining me now is Bloomberg's Jonathan Tamari. Jonathan, I mean, we knew this was going to be dead on arrival in Congress, but the Senate turning, this sort of, throws all the political cards up in the air. First take.
Yeah, I mean, it was stunning to see the speed with which the opposition came out in the Senate. As you point out, the House had made their intentions clear, but there have been many senators, including Republicans, who had said that they wanted to see a compromise here, that they wanted border security linked to foreign aid for Ukraine and other American allies. And they seemed to get what they wanted with this deal, yet they came out very quickly against it. And that just kind of shows how the politics have shifted with Trump nearing the nomination to become the Republican nominee, that now they're rejecting exactly what they had asked for. And it leaves this huge question about what's going to happen with aid to Ukraine. It's hard to see what the path is at this moment to see how that can get through both chambers of Congress.
Yeah, and that chasm opening up between the United States financial support for Ukraine and the Europeans. We did take their time to get there, but they got there. This differential will not be lost on Putin. Jonathan, thank you very much. Jonathan Tamari there. Let's pivot to UBS. Share buybacks. They're everywhere in Europe. And today, it is UBS vowing to hand back as much as $1 billion to shareholders in the second half. This as it seeks to move beyond the integration of Credit Suisse. CEO Sergio Motti spoke to Bloomberg's Francine Lacroix a little bit earlier.
One thing that we need to do is to be willing in the next couple of years to sacrifice a little bit of top-line growth in order to improve the returns on our financial resources, particularly on the balance sheet.
Let's get a little bit more with Steve Ahrens, who's covering the UBS story. I mean, this is Motti talking about a prudent approach to share buybacks. I'm quite surprised the share buybacks are back as early as they are. That should have been a shot in the arm. What has been the detraction today in the UBS story?
Well, yeah, I think you're right. The buybacks, unveiling them now, that's actually positive news for investors. UBS is back buying its own shares, or will be back in the next half of the year. But there was a quarterly earnings miss. Net income was below estimates. So I guess people were just expecting a little more. This poses questions about the future. The wealth management unit didn't perform as expected, which is the engine of Amorti's plan. And if that shows weakness, investors ask, okay, what does it mean for the future?
Yeah, well, certainly it's going to be interesting to see, did they pick up any flow from Julius Baer with the ructions that they've had down the street on Bahnhofstrasse, and maybe the market is unimpressed with these targets that they've set. Perhaps the benchmark just isn't as high as the market had hoped. Steve, thank you very much. Steve Aarons, great work as always on UBS and Deutsche Bank. Morning calls. This is what we've got for you. Academy's Peter Cheer joins me on why he is not convinced the economy is about to take off. Doom and gloom, you got it in a couple of minutes.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
We will not be defied. That's essentially the message from the equity market. You might have job cuts coming through from DocuSign, yesterday from Snap, but these equity markets are robust in the face of a 27 basis point lift in 10-year government bond yields, likewise at the short end of the curve. The breadth of the market is where you've got the laggards on the Russell 2000. Roll it over, have a look at the bond market, because this is where the potential spoiler alert comes. But at 445, you've got a pretty sizable offering of 3s, 10s, and 30s, and a chunky 30 billion of corporate debt to come and hit the street this week. How will that be absorbed? Buyers of the world, unite. Let me give you your morning calls this Tuesday on Wall Street. The scribes say this. First up, BTIG downgrading McDonald's to neutral, anticipating a modest earnings growth amid a weakening in the consumer. Next up, UBS upgrades UPS to a buy, expecting management to deliver effective cost-cutting measures. And finally, Daiwa downgrades Tesla to neutral, growing increasing concern about the company's corporate governance. The stock is down 1.61%. Academy's Peter Cheer joins me in just a moment. We'll talk about rising bond yields. And he's not convinced on this economy.
there is no digital without chips. And I emphasize that because everybody speaks about the digitalization of the world. And I would even go a step further. There is no Green Deal without chips. So yes, it's a bit like the new oil for the world. And given some of these geopolitical tensions, especially between the US and China, it's become a necessity, I believe, to be more resilient against these geopolitical tensions. And while finding it out the hard way through the past 2 years during the pandemic, and what I mean with the hard way is that we've all seen how key industries in Europe and the US, especially in the industrial, medical, and automotive sectors, have suffered from a shortage of semiconductors.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
I love family days. Look at that. There you go. Bring your kids to the NASDAQ. It's a big day for Copilot. Can they live up to the technology dream? A lot of tech job cuts out there coming down the pike. We'll talk more about Spotify in just a moment. For now, you have a resilient, robust equity market that is casting off the rise in yields. You have good technology reporting earnings. You have a sheer defiance here. S&P 500 up by 0.2%. Roll it over, have a look at the rest of the markets, and you begin to understand what's going on around the risk this morning. Flat on the euro dollar. The dollar, of course, having made the highs against multi-currencies, the highest since November of last year. Yields ticked down by a pip. Don't get too emotional about that. You put on 27 basis points in the space of 2 years, the biggest two-day run since 2022. Crude oil is up 0.7%. The story in crude is more about dividends. Dividends and buybacks from BP, Exxon, the gargantuan buybacks that you've got out there. Javier Blas's opinion column is something to read, to understand what's going on there. I mentioned Spotify at the open. It is one stock to watch, posting better than expected subscriber growth, and that's thankfully a successful promotions campaign that went on and keeping the costs in check. Thing of beauty, up 9% on the day. Rounding up, Abigail.
Yeah, well, the stock is really surging. The best day since October of last year, Manus. This, of course, after they did post that better number of subscribers than expected. But lots of good things happening here. So their monthly active users jumped 23% to 602 million. That's Spotify's second largest gain ever for the quarter. The company also is continuing to cut costs to become profitable. In December, they did lay off 1,500 people, one of those many tech companies that seems to be doing that, as you've mentioned. They are also paring back on their podcast expenses, allowing some of, in addition, their popular podcasts to go to other platforms to generate bigger audiences and to generate some of that ad revenue. Despite being unprofitable, when I took a look at these shares into today, since the December 2022 low, Menace, this stock up more than 200%. Really pretty amazing, adding to those gains today.
I just want to put it out there. I'm cheaper than Joe Rogan. I'm happy to re-ink a podcast instead of Joe Rogan if they want a little bit of cutting the expenses. Abby, thank you very much. The stock is up 8% on Spotify. Let's stick with the earnings. Eli Lilly blowing past the estimates after a strong launch of their new weight loss drug and higher prices for their diabetes drugs. Simone Foxman has the division. Simone.
Yeah, there were great expectations for Eli Lilly going into this fourth quarter report. And Eli Lilly pretty much exceeding all of them. When you look through the major metrics here, earnings per share, $2.49 per share, an estimated $2.18. Gross margin coming in better than expected. Even revenue up 28% on a year-on-year basis. This was largely driven by sales of those GLP-1 drugs like Mounjaro, especially in the United States, where revenue increased 39%. Diabetes treatment Mounjaro, this is the rival to Ozempic. It's used widely as an off-label weight loss drug, outperforming its previous best-performing drug, Trulicity, for the very first time. This is also a GLP-1, and it seems to be cannibalizing sales. As you mentioned, though, Zepbound coming in hot after getting FDA approval in November as a weight loss drug, seeing $176 million in sales versus an estimated $141 million in sales. We're looking for increasing talk on the call at 10 a.m. About continued delays in production in a lot of these major GLP-1 drugs. Citi, though, saying that the overwhelming beat on Mounjaro as well as Zepbound is validation of both demand and supply. And really, the only concern for them is 2032, when some of these drugs are going to be available in generic format. That is a long time away. And so these earnings results injecting a lot of optimism into the shares this morning, up now close to 3%. Manus.
Simone, thank you very much. Let's turn our attention to Hertz. The rental car company misses its estimates as it sells its fleet of Tesla EVs. Isabel Lee has more on the story. Have Hertz said why and how much they're selling?
Hertz is definitely hurt by this, and they're selling around 20,000 Tesla EV vehicles. That's 1/3 of their fleet. So it's really the offloading of Tesla that affected Hertz. The company reported an adjusted loss of $1.36 per share. That's lower than the 76-cent analyst estimates. And this is also coming from a profit of $70 a quarter ago, 70 cents rather, and 50 cents a year ago. And it's the decision to offload Tesla shares that pushed them deep in the red. Hertz said that they lost money renting Teslas out. And as we know, Teslas has been implementing a series of price cuts, and more broadly, there's just really a slowdown in EV vehicles. And this is a big blow to Hertz because they're one of the companies that embraced the EV revolution, and now they're kind of reversing, and it's really hurting sentiment and hurting their shares. The company is now hitting a record low. It's lower now by 5%. Hertz reported quarterly revenue of $2.18 billion. That's largely in line with analyst expectation. And so far, the stock has fallen 21% this year, Manus.
Isabel, thank you very much. More bad news there for Tesla as well as Hertz. Peter Cheer is of Academy Securities, possibly putting back on his economic outlook. This is what he's got to say to the market. I'm not convinced the economy is about to take off, but I'm reevaluating that urgently. Now, Peter, good morning. Good to see you. What are you reevaluating? Where's the sense of urgency? And how are you striking? Good morning.
Good morning. I really thought we were going to head into a period of slowdown in the economy. It was going to be rolling throughout the country, through different industries. But all of a sudden, the jobs report was so strong last Friday. We've seen some other signals. And I always go back to the Citi Economic Surprise Index, and that has bounced significantly since the middle of January. And I kind of poo-pooed some of that. I could find reasons why maybe spending was overstated. Various reasons, but I'm now trying to dig deeper. Could we actually avoid any sort of landing and really have this sort of trampoline effect? I don't see it, but I'm now worried about it, and it wasn't a worry for me as a economic bear a week ago.
I mean, that's a heck of a pivot in the space of a week. What would be a trampoline moment? Where would you just say, actually, I'm going to throw in the towel here. I'm convinced now. I am absolutely convinced.
I think if jobs are really coming back as strong as they seem to be, if AI is really catching on, and not just people dabbling in AI or using AI, but actually demonstrating success, that they are getting a good cost benefit from using AI, then I think I have to throw in the towel on this bearish outlook. At the other end, you've seen some problems in commercial real estate. So there's offsetting, and I'm not there yet, but all of a sudden you can see this potential for a real takeoff in the economy.
I recommend everybody goes back and reads Alan Greenspan's discussion. He wrote a paper, I can't quote all of it, his discussion around the new paradigm, which is back in a period of time when we had the evolution of the internet, the democratization of the internet. What would that mean for efficiency, for productivity? And I think we're at, what does anybody care what I think? We're at some kind of an inflection point with productivity and technology. Peter, you mentioned the regional banks and commercial real estate. Last year, you were bullish, not evangelist, you were bullish. You were recommending CRE and regional banks for much of last year. You cannot decide whether last week was idiosyncratic and a great buying opportunity or not. Again, what is it that would turn you from unsure to an assurity of going long?
Right, so we had such a good run into last year, we kind of recommended reducing exposure. Right now, we're seeing a few isolated events. I do think positives for commercial real estate. A lot of the big projects are well-funded. They're backed by big people who have plenty of money. The rates are higher, but they can get renegotiated. There's a lot of stability. I do think we're going to see 2024 as a return to work from the office, so that's going to be supportive of real estate. There are going to be individual cities and regions, I think, that struggle. So my only concern is, does this really hit the small, the 10-unit multifamily thing and creep up from there? I don't think we do, so I'm getting positive, but I want to watch a little bit more data, get a little bit more anecdotal evidence that this is a small bank issue and not something that creeps into larger real estate and larger banks.
Okay, can we just step back for a moment and go back to where we started? You said, look, Manus, I'm ready to be convinced. I'm ready to act urgently and reconsider my position. If you look at the base case of no landing or quasi-soft landing, Ian Lingen is on the IB with me at the moment at BMO, and he's saying, listen, this is a 10 to 15% uplift in equity markets if that's what comes to pass, but you're not going to get an excess of 20% like you had late last year. So what kind of return in this quite holistic environment that you say you wait to be convinced of can be delivered in equities, and how does that transfer across assets?
Yeah, I think it can be delivered in equities, and if all of a sudden the economy really is avoiding any landing and is starting to reaccelerate, if we start feeling the benefits of onshoring and reshoring, so there's better jobs domestically, you start getting these foundries ramped up, I think you can easily get above 20% if that's the theory. I think technology is going to lead the way probably for a little bit, but I think you're going to see a much more broad rally as producers do very well. I think the Russell 2000, the banking system. So I would want to own everything, be heavily overweight the non-big tech. I think commodities will do well. I think energy is going to be one of the great stories where we seem to finally be getting our act together and realizing if we want sustainable energy in the future, we have to outbuild sustainable faster than we've been building it, but we also have to make sure we reinvest significantly for the next 10, 20 years in traditional energy. I think that's going to be huge for the commodity space and commodity-related stocks.
I'm sort of torn here. I've got a quasi-European narrative, which is UBS share buybacks, BP share buybacks. I mean, Exxon and Chevron have also been gargantuan share buybacks. Maybe big oil trades at a valuation discount because of all of the headwinds of whether you want to own big oil. But when you see this buyback wave coming towards us in January during this earnings season, how important is that to portfolio construction?
Certainly it helps, right? It says that they are going to, reward shareholders for the risk the shareholders have been taking. But I think all those companies you mentioned, right, they're all in the process of transitioning themselves from big oil to big energy. And I think that's what we really have to be thinking about, is thinking of these companies as good at getting energy out of the earth, and if they happen to do it one way for decades, they're going to do it other ways. So that's why I like them so much. I think they've got the resources, the money, and the expertise to transition themselves, and that's where you're going to see that benefit, right? They will figure out how to maintain what we have, grow to the future. They will all look very different 20 years from now, and you want to enjoy that ride, I think.
Enjoy the ride. Well, certainly enjoy the buybacks. I mean, it's amazing, isn't it, the differential between what Exxon and Chevron are doing relative to the size of the BPs of this world. Let's square it away. Since you lack conviction on what's going on with the regional banks, I just wonder what that means for credit.
I think credit as a whole is going to do fine. So large corporations have always depended on the larger banks and the public debt market. That's going great. And I think we've been highly recommending to our client base that they overweight corporate credit versus treasuries. I just think you're getting paid excess returns. You have less risk. A lot of the corporations are better governed than our own government, right? They don't talk about not paying the debt. So I want to be overweight that. And I think private credit is stepping in for the smaller institutions. Yes, you're going to have to pay a little bit more as the banks are kind of, on their back foot. The small banks, they're not lending as much. Private credit is filling that gap reasonably well. So I think credit's going to do very well. It's going to be a success story. And if we're right again, we get this sort of rebound, you will see credit spreads contract, and you could actually see some M&A activity, which would really help the high yield market.
Well, I'll leave you with this thought. Sometimes the shareholders can be more brutal than the voters of a country. Peter Cheer, thank you very much. Peter Cheer of Academy Securities on his calls. Cuts, they're continuing in the tech sector.
Initial jobless claims never spiked up to a significant level, which just suggests that there is still demand for those kind of workers outside of tech or at different companies.
That big conversation next on Bloomberg. Good morning.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg. Context changes everything.
The interesting thing about those tech job cuts is that it appears as if people who were laid off were able to get work rather quickly, as we never saw a very weak non-farm payrolls print, for example, or initial jobless claims never spiked up to a significant level, which just suggests that there is still demand for those kind of workers outside of tech or at different companies. But it is important to watch if some of the weakness around the edges of the job market become more pernicious and actually point to a weaker job market ahead.
Cameron Dawson of New Age Wealth speaking to me yesterday. DocuSign kick off today announcing this morning they are laying off around 6% of their workforce. Spotify reports results this morning, another of those companies to make significant layoffs. Now, the streaming service is cutting 17% of the workforce back in December. The company putting focus on increasing its revenue. Katie Greifeld is with me this morning. Look, there's a myriad of estimates out there, but big tech is taking the knife out to jobs.
Big time, and you're seeing that this morning. Let's start with the details on DocuSign there. Of course, this comes after the company is looking to cut costs after reports to try to sell itself. Apparently, those efforts have stalled. That is according to people familiar with the matter. As a result, DocuSign going to cut about 6% of its workforce. And like you mentioned, Manus, I mean, this is part of a growing trend. We heard from Snap just yesterday that it plans to reduce its workforce by about 10%. Earlier this month, we heard from Okta, similar plans there. And in December, like you said, Spotify announcing that it's cutting 17% of its workforce. And all told, estimates do vary, but 32,000 tech workers have lost their jobs already in 2024. That is according to data from layoffs.fyi. And the bulk of that is coming from the big employers, think Amazon, Salesforce, and Meta. And the reasons why, they do vary by company, but the common denominator seems to be that this is a sector that really overhired during the pandemic. And as such, you're seeing this industry still trying to right size coming out of that. And as a result, that's why you're seeing these job cuts in certain departments. It is important to note that you're still seeing aggressive hiring in other departments. Actually, if you take a look at CompTIA, there are about 33,000 active tech job postings in January. And that dynamic, that cost cuts, that refocusing is probably why you're seeing these companies get rewarded in the stock market.
Okay, Katie, thank you very much. Certainly Spotify, look at that, up 8.8% this morning. That is Katie Greifeld. Well, the Treasury Secretary, Janet Yellen, is due to begin testifying at the House Financial Services Committee on the annual report of Financial Stability Oversight Council. Bloomberg's Mike McKee joins me now for that conversation. Mike, what can we expect? I mean, we had the SLOOS report yesterday. We've got Bank Corp last week, New York Bank Corp last week. Where do you think this conversation is going to begin and end?
It probably begins with Janet Yellen telling the committee that things are pretty good out there. The economy is in good shape. I'm sure she's going to echo the Fed chair at his news conference and then on 60 Minutes saying this is a good economy. Unemployment's still low and inflation is coming down and growth is still high. But then you'll have members of the committee ask her about various things that could go wrong, and that's where some of these things like the banking system come into place. Yellen is going to tell the committee that the government's FSOC committee, the Treasury Department, the Fed, the Office of the Comptroller of the Currency have tightened regulations and have tightened supervision of banks, and they are much safer. They don't think that there's going to be any kind of systemic problem as there was with SVB, but she's going to talk about the need to continue that and perhaps have additional regulatory powers granted to those agencies to be able to stay on top of what's going on. Then, of course, you've got other things like climate change menace that'll be coming up. The regulators want to be able to consider climate change impacts, like if you're going to borrow money, is what you're borrowing money for going to end up underwater, or in more than one way,
quite literally,
or something like that. So there's going to be a lot of political questions in there, as well as Yellen's description of the economy being pretty good.
Look, she is ex-Fed. There's going to be talk around rates. There's going to be talk around this economy and how strong it is as well. Given what Katie and I were just chatting about there, these are idiosyncratic job cuts, but there is a cumulative effect to these job cuts that are coming through on tech. Do you get a sense when you look at the data that we're going to get slightly hotter reads on jobless claims as these tech jobs, they're piling up at the moment?
We may get slightly higher jobless claims. The question is then, do people get jobs fairly quickly
in the AI
that?
switch, perhaps?
It's really hard, though, to keep track because these are all tech jobs, which basically means they're higher paid, and people are going to get severance, and they can't apply for jobless benefits until their severance runs out. So this could take a while to show up in the data. It's also not that many people on a national basis, so it doesn't really show up in the data yet.
It's just a question of whether it's a canary in the sentiment coal mine of the jobs market. Mike, thank you very much. That is Bloomberg's Mike McKee with the very latest. Let's hear from Yellen a little bit later on. It's 9:51. She'll be on the tape just after the top of the hour. Some sector price action for you. Abigail Doolittle is with me as ever. Abby, what have we got?
Well, we have a very small gain for the S&P 500, low volume. Relative to the composition, though, it's extremely broad. Materials the best, rebounding from yesterday's big drop, up 1.4%. Then healthcare and real estate also up solidly. The rest of the sectors that are higher up less than 0.4%. To the downside, you have tech down about 0.4%. So not a lot of movement here. Let's take a look at what's happening on the year, though, because it is pretty interesting. We have not seen the diversification, the breadth that everybody wanted to see at the end of last year. The top two sectors, communication services up 10.5%, tech up 7%, and then we have a number of sectors that are down on the year, including utilities and real estate. Well, they are both down more than 5%. So this year's rally, it's certainly not coming from non-tech, non-Magnificent Seven sectors, at least yet.
Abby, thank you very much. Abigail Doolittle there. Coming up in the show, market-moving events that will set the agenda for you. What a beautiful day in New York City. Good morning. The sun is shining and stocks are bid.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
If you believe in the strength of the landing in the U.S. economy, maybe the dip that you've had in the Russell is an opportunity to go for breadth. The NASDAQ is just flat at the moment. There's an underbelly. Tesla is down. Spotify are cutting jobs. DocuSign are cutting jobs. So it's not that the unemployment scenario is running away with itself on the upside. Roll it over and have a look. You've got the beginning of a trifecta of bond auctions this week. 3s, 10s, and 30s right at the very, very long end of the curve. Today, you're going to see 3-year paper in terms of the size there. How easily is that absorbed? You've got corporate issuance this week of about $30 billion. 10-year government bond yields dipping back ever so slightly at 4.13. And then, of course, will you be able to absorb all of the supply at the longer end as we go towards the end of the week? Let me set you up with your trading diary. She votes. It is Ms. Mester. She is the Cleveland Fed president, and she will speak at noon Eastern. More Fed speak throughout the day: Kashkari, Collins, and Harker. So you have a quartet to digest. To Ford, the earnings come after the bell rings this evening. Disney, a whole new world, will turn in their report card as well. That is tomorrow after the bell. Thursday, Treasury Secretary Janet Yellen testifies to the Senate. On Friday, CPI revisions. I like a bit of Disney. That was Countdown to the Open. This is Bloomberg.
reception, the acceptance of Purosang has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Purosang all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Bloomberg Intelligence, Alex Steele, Paul Sweeney live with you here. Bloomberg Intelligence, one of the largest and I would argue the best investment research shops on Wall Street. Over 400 professionals covering 2,000 stocks, 130 industries, equities, fixed income, commodities. They do it all, and we like to tap into those smart people to talk about stocks, talk about markets, and we will do that today. We're going to talk to Ira Jersey from Bloomberg Intelligence. He runs all the U.S. interest rate strategy work there. I want to see what he's thinking about this Federal Reserve. Are they going to cut rates? When and how deep? We'll get into that. Plus, Allison Williams, she also covers the banks for Bloomberg Intelligence. We'll get her thoughts on UBS and some of the European banks that are going to be reporting here. But we're going to kick this whole thing off right now. Mr. John Tucker in Bloomberg Business Flash.
And we are sponsored. This market driver report, the Bloomberg Market Check, brought to you by Interactive Brokers. The Interactive Brokers charging U.S. dollar margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. Well, stocks higher in the early going, right now turning mixed. In the S&P 500, we had 7 of the 11 major industry groups up. Leading the way were material stocks. That's where you're going to find shares of Linde, the industrial gas and engineering firm, delivering earnings guidance better than expected. Investors today also waiting for a bunch of Fed speakers as well this week. And meantime, Julia Coronado at Macro Policy Perspectives believes the Fed is very close to its goal.
As we saw on Friday, data can always surprise us, but if inflation does continue to behave as it's been, they're rapidly approaching 2%.
Well, despite Friday's bang-up jobs report, we do continue to hear more about corporate layoffs. DocuSign, for example, cutting about 6% of its workforce. That's part of a restructuring. S&P 500 right now Down 1 point, 49.41 on the index. The Dow Jones Industrial Average, 78 points higher. That's up 0.2%. The NASDAQ 100, that has now turned lower. That's down 60 points. That is down about 0.4%. And as we look at treasuries, the 2-year, now 3 basis points lower, 444. The 10-year, down 2 basis points. That's at 413. And this crossing the Bloomberg, the Securities and Exchange Commission set to label hedge funds trading U.S. treasuries as dealers. And it's going to take somebody smarter than me to explain that one. So I'm going to throw it back to Alex and Paul.
He said Alex.
Yeah, I know.
You
He did. He led with that. I saw that.
There's nothing implied in that.
But we can get some of the details. But basically, this means that they'll have to hedge funds will have to register as dealers, which from the Fed push, it helps liquidity issues.
Yes.
But it also subjects hedge funds to a little bit more capital requirements and oversight. But apparently, there's no dollar threshold, and they soften some other aspects of it. So it's like expected and also a little bit of a win.
Okay.
So you are the smarter of the two.
I know.
I had more time to read in because Paul is doing the open. That's literally all I got for you.
All right, John Tucker, thanks so much for that. We appreciate it. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Another red headline crossing the tape. Trump denied immunity in D.C. elections case by appeals court. So for those following that story, we'll have more reporting on that coming up. But that is an issue for the former president. Looking at the markets here, Alex, it's just kind of mixed. I don't see a lot of direction here today. We're going to have a lot more earnings been coming out today. Another busy week for earnings. Kind of a mixed bag across the board, but there's, I think the market's kind of looking for a little direction here, perhaps from the Fed.
Yeah, and it's interesting because individually there's some fun stories and stocks are moving, but on a macro narrative, I just don't know what it is right now. We had a pretty exciting 2 days, and now everyone's kind of hanging out and chilling for a little bit.
Yep, absolutely. So we'll have that.
That's my smart takeaway for you.
Oh, I'm good. That's good enough for
chilling.
me at 10 o'clock in the morning. Nora Melendez joins us here. She covers all of the markets for Bloomberg News, and she's probably got some stories because there are a lot of earnings out there. So let's get to it. Nora, what are you looking at?
Let's take a look at DocuSign. As John Tucker talked about earlier, we're looking at DocuSign. It cut 6% of its workforce as a part of a restructuring effort. This is after apparently talks to sell itself have stalled. Independent talks with Bain Capital, Hellman, and Friedman about acquiring it, but those discussions seem to have fallen through. That's all according to Reuters. And mostly this should affect its staff in sales and marketing. And it was once a pandemic darling, but DocuSign has been hurt by increasing competition from Adobe's document business.
You know, I remember, sorry, go ahead.
No, I just love DocuSign. Just, got a mortgage about a year ago. Instead of going to a lawyer's office and signing papers for an hour, just click, 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 click,
click,
boom.
click away.
Done.
It is amazing. And for a moment, you're like, but what am I clicking?
What am
and
I-
then you're like, you know what? It's okay.
You're
I'll just
clicking
go with it.
away
You're
and
moving
signing
so
away
fast.
your life.
Yeah, but it was easier and it saved me time. But I remember people talking about how we'll know when the pandemic is really over when DocuSign tanks.
Yep.
People have been saying that for that exact reason.
And yeah, we're seeing it fall. So right in line with what those expectations were. Looking at Eli Lilly, this is an interesting one, of course, as we've been thinking about a lot of these weight loss drugs. Eli Lilly is climbing as much as 5.1%. That's its highest intraday level on record. It forecasts 2024 sales ahead of estimates as the company is rolling out Zepbound. That is its weight loss drug. It's a shot that's widely expected to become its best-selling drug ever.
Wow. And for Lilly to say best-selling drug
Right.
ever.
Amazing.
But what I hear from folks is you can't get this stuff. I mean, it's such, they have to crank up, I guess, production for because the people that are trying to get it, they don't need it for obesity or diabetes in a lot of cases. It's just, I need to lose 10 pounds.
Right, and that's exactly the situation. I mean, we are seeing a high amount of demand, but not enough of supply. So that's what some people have really been complaining about. But there actually is, while Zepbound is part of the hype, investors are also looking at a pipeline of drugs that it has. It's next generation treatments that, with the shot, it apparently helps patients lose roughly about 1/3 of their body weight in trials. 1/3.
Did you see this great story that because you lose all that weight, you need Botox? Oh, so everyone's trying to get on like the ancillary weight loss drug thing, and there was everyone's talking their book, but basically you get the saggy face thing because you lose so much weight so fast, so you need the Botox to lift it all up
to balance it back out.
Yeah, you're looking at Hertz too.
That's a fun one. Hertz.
Where do you go from there?
Right, yeah, where do you go from there? Hertz is looking to cut costs after a fourth quarter earnings miss. We are seeing those shares up a little bit, but earlier they were falling after it reported it lost an adjusted $1.36 per share, which is worse than the 76% loss that analysts have projected for that quarter. It said that it's selling 1/3 of its EV fleet, and as we know, this was essentially, ultimately, as we started this morning, a big blow to the company, especially as we think about it being an earlier embracer of the EV revolution. And the CEO did say that it plans to cut $250 million in other costs, which could potentially include layoffs. But we are seeing the stock popping up a little bit right now as we speak. So it does seem that investors are really digesting this information, and it's not hitting it as hard as it was before.
I'm a Hertz Gold customer. I have to admit, I'm a pretty happy customer.
Wait,
I get
you
to the
own a
airport.
car.
No, but I travel.
Oh, okay.
People travel, and I don't bring my car when I go to, California, say. Go into the airport, Sweeney name up there, boom, walk in, pick any car you want. It's pretty cool. And you come back and just dump it. I don't know.
I can definitely see Paul Sweeney on a line not enjoying that.
Yeah, I don't do the lines.
I can
tell you what, you get out of San Francisco airport and you get on the tram and it takes you to the rental car place. It is a mob there. And I just walk down, right to my car. See ya.
This all tracks.
Exclusive access.
Yeah, that's how you do it.
All right, Norma Linda, thank you very much. We'll see you at the top of the next hour. We appreciate all that update. As John Tucker was talking about, I don't know, yield just really going nowhere after 2 days. I mean, at one point, Paul, we saw the 2-year yield up 26 basis points in 2 days. We haven't seen that kind of move since February of last year.
No, exactly. And you get the strong economic data, and you make the argument, not only is March off the table, but now some folks are even questioning here for May in terms of a rate cut. And, so what you get is you get short-term rates popping higher here. So interesting. So who we can talk? You know who we can talk to about this stuff?
Yeah, we should do that.
Is Ira Jersey. I mean, the guy, he's from Bloomberg Intelligence, his U.S. interest rate strategist. Somehow he's made a career out of talking the Fed. I have no idea. We pay him. The check's clear every 2 weeks, and he's one of the best on Wall Street. So we appreciate getting a couple minutes of his time. So Ira, I mean, talk to us about May here. All right, March is already a thing of the past. Nothing happening there. What do you think the Fed's thinking about when it comes to the May meeting?
Yeah, I think the Fed really wants more data, right? They're waiting for, all the February, March, and maybe even a little bit of the April data, at least the early April data that we get, like the ISM surveys and a few other things that we'll see before the May meeting. I think the challenge for the Fed right now is that as inflation continues to moderate, they really don't want the difference between inflation and the Fed funds rate to get too wide. That's what we call the real federal funds rate, because in the Fed's view, that is what tightens monetary policy a lot and tightens financial conditions. And they're worried that if they wait too long to start cutting interest rates, that will just get wider and wider. So I think the next couple of inflation prints are going to be exceptionally important for that. So the February and March prints we'll have prior to the next Fed meeting, both CPI and the PCE deflator, which is the Fed's preferred measure. And once we know those data, we can make a better assessment as to whether or not they'll cut in May. I personally think that they're still going to cut before the middle of the year, because by cutting one time, that gives them the ability to then cut later if they need to, even in the middle of an election cycle. Whereas if they wait until September and then cut interest rates 50 or 75 basis points because things are falling apart, they'll get criticized for that politically and say, oh, they're trying to help the Biden administration or something like that. And I think that to avoid that, it just makes sense for them to cut sometime before.
Hey, Ira, I wonder, are we in a world where the Fed's actually going to be cutting less than the rest of the world? Because that would be a very different spot than where we were like 3 weeks ago.
Well, I think it depends on your time horizon. The Federal Reserve has a lot more room to cut than, say, Europe does, right? The European Central Bank doesn't have as much room to cut unless they're going to cut rates to negative again, which is, of course, possible. But I think, the ECB probably wants to try to avoid that this next cycle. I do think this year it is possible that the Fed will cut a bit less than some other central banks, like the Bank of England, for example, and in part because there are different different inflation dynamics in both of those countries, so it makes sense for the monetary policy to be a little bit different. We're still in the 75 or 100 basis point cut camp. I know, our friends in Bloomberg Economics have slightly more than that. The market's still pricing for more than 100 basis points of cuts. So I do think that the market is still kind of in risk management mode, thinking the Fed's going to cut more. I'm not as convinced of that and never have been. So, I'm looking for kind of a May start and then a July cut and then November. December will really depend, right? There's so much data and a lot can change over the next 9 months in order for us to know whether or not the Fed is likely to cut in December or not. But let's get through the first, let's get through the first 1 or 2, and then we can determine what the path is.
And Ira, are these 50 basis point cuts we're talking about, or 25 an option?
I think just 25s, at least the start, and because the economy is not slowing down, right? I mean, we saw that just last week with all the data that we've received. You look at things like the retail sales data, and you look at even the personal consumption report. I look at the quantity indices, so just the number of transactions that's going on. So the real, the real economy and what's happening under the hood, and that's still accelerating, especially for services. So we actually have durable goods sales are rolling over a little bit, but the other sectors are doing great, right? So it's hard to see why the Federal Reserve would need to cut at a pace faster than 25 basis points. Importantly, Paul, it's what do they do the second month, right? Okay. So if they do cut in May, as we expect, and the market's probably going to price for them to be cutting almost every meeting. And then if they skip June, that's when you wind up having the market say, okay, maybe it's an every other meeting move, and we can shift the whole curve.
All right, Ira, great stuff. As always, Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. I want to get back to that news that just broke recently. President Trump denied immunity in D.C. election case by appeals court. We want to get the latest reporting on that. We turn to Chris Strum, Bloomberg News legal reporter for us down in Washington, D.C. Chris, what can you tell us about this ruling from the appeals court?
Well, it took a month to come, and we've all been waiting for this, but it's finally out. The D.C. appeals court has denied Trump immunity for being prosecuted for election interference in the 2020 election. This is what we've been waiting for. Trump argued that a president should be immune for actions taken. The appeals court issued a unanimous ruling that Trump is not immune. Here's a key sentence from it. Former President Trump's alleged efforts to remain in power despite losing the 2020 election were, if proven, an unprecedented assault on the structure of our government. And basically from there, it just picks apart Trump's argument.
So, Chris, this just goes to the Supreme Court, right? So is this just the Supreme Court eventually deciding basically presidential election in some capacity again?
So Trump has the right to appeal to the Supreme Court. The Supreme Court doesn't have to take it. So the appeals court said they will put the ruling on hold, and Trump has until February 12th to make a decision on whether to appeal to the Supreme Court. And when he most likely will, but the question is, will the Supreme Court take it or not? So if the Supreme Court does not take it, then the court will order the district court to go forward with the case, which is the process by which the trial will be held.
All right, give us, if we know, Chris, any sense of timing about how some of those if-thens can occur?
Yeah, well, the trial was originally set for March 4th, and the judge in the trial has already canceled that date. Trump will be afforded the time that has elapsed this last month that has elapsed since the appeals court took their time making this decision. So most likely that you wouldn't see a trial until at least May at the earliest.
Is there any sense as to what the Supreme Court might do? Is the expectation that they will take it up or they will not?
Well, part of what happened is the judges took their time writing this opinion, and they came to a unanimous agreement. And that was key to signal to the Supreme Court how solid this opinion is. If there had been dissent in this opinion, then that would open the door for the Supreme Court to maybe there'd be more of a chance that the Supreme Court would take the case. But with a unanimous opinion, and given that the Supreme Court is already embroiled in some other, really politically hot potatoes, it's possible that the Supreme Court takes a pass on hearing this case.
Yeah, I bet you they want to.
Yes.
That would be probably a better moment for them. Chris, thanks a lot. Really appreciate it. Chris Storm, Bloomberg legal reporter. No doubt, I feel, we're going to get more of these red headlines.
I don't think they would pass on a case so important. Just to weigh in with some sort of an opinion, not necessarily reverse it, but it's an historic time. And the Supreme Court taking a pass on this?
Well, I mean, are they in the business of deciding elections or having?
Well, this would be the second go.
Yep.
Right.
Yep.
They did 2000.
Yeah. So anyway, brush up on your legal work. I mean, I took one class in Duke Law School. I mean, I think I'm ready to go.
I worked at a law firm.
This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. S&P 500 right now, little change. The mega caps, they're mixed. Tesla up, NVIDIA shares, they are lower. Traders will be focused on remarks from Fed officials for any clues on the path of policy. And then on the earnings front, here's your scorecard. We have 256 of the 500 companies in the S&P 500. They've reported so far. As far as earnings growth, positive surprises on earnings growth adds up to 60% of those that have reported so far. In the S&P 500 right now, dead flat, 49.42 on the index. The Dow Jones Industrial Average is up 71 points. That's a rise of 0.2%. The Nasdaq 100, 48 points lower. That is down 0.3%. And yields are lower. The 2-year, which is more policy reactive, that's 5 basis points lower right now. That's at 440. The 10-year, the benchmark, 5 basis points lower. That is now at 410. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Alex and Paul.
And Alex, John has to cover the markets even when there's nothing going on, like today.
Well, I'm looking for like a theme to latch on to.
Today's tough.
Maybe our next guest can help us out. But we'll put him to work here. David Bahnsen joins us here. He's the Chief Investment Officer for the Bahnsen Group. David, again, John Tucker was looking for some theme to talk about here in this market. I don't see a lot here. We got a ton of earnings going on out there, but it seems to be everybody's just kind of waiting on the Fed. I don't know. What are you guys looking for in terms of direction in this marketplace?
I always am looking for company earnings and actual activities from the businesses we invest in. In other words, a day like today is the way it's supposed to be. You know, the market's trading around the size of the briefcase Jay Powell carries to a press conference. It strikes me as very unhealthy. Market's trading around Simon Property having a blockbuster earnings result last night. Now that makes a lot of sense. So you see the largest mall operator in the country up 4.5% today. It was a name I talked about with you guys last time I was here. We're bottom-up people. We're markets are businesses doing things kind of people. I'd like to see less of the obsession with Jay Powell, quite frankly.
Okay, so then what do you like? Like, what's working bottom up?
I think bottom up, you have to look at the spaces that are not overvalued, even though some of those overvalued names have done well. It's not been the quarter everyone seems to think it has for Mag 7. But Tesla's gotten crushed, and Microsoft had good results, but not a great stock result. Facebook had a huge upswing on a dividend announcement. It's been very mixed. We're looking at things like consumer staples that we think are showing their pricing power, growing dividends, and if it is going to be a boring year, that will be a good thing for sectors.
But does that mean that you sell tech, or you just don't want to buy them here?
Well, for us, we don't have to worry about selling it because we didn't buy it to begin with. And
so you don't own any of the big Mag 7 or 6?
Not a single one, and so that's why our...
Is that a valuation call, David, or...?
It's totally valuation call.
Okay.
These are 7 of the best-run companies in history that have done extremely well, and they have a blended negative return over the last 2 years. And I don't think people realize that because 2023 was so good, but it was mostly just offsetting what was so bad in 22. And we think that's what it's going to do. That's what companies that trade at 30, 35, 40 times. You know, Facebook right now has a higher forward multiple than it does backward after last week. That's just crazy.
So how do you screen for stocks? What's important to you guys at the Bahnsen?
Dividend growth. So it starts with companies that have a dividend higher than the S&P. Generally, we want 100 basis points or so higher than the S&P, but then a track record of growing the dividend. From there, that's the screen, as you asked. Then we start doing our work. Then we have to research. We want management that's committed to the dividend, committed to growing it year over year. They can only do so if they have a company that has recurring free cash flow. So if the free cash flow or the business model itself lends itself to lumpy earnings, it may not be a good dividend payer. It has to have a strong balance sheet. It's a little bit more boring. You get a lot in healthcare. You know why we did so well last year was financials. The asset managers, Blackstone was up over 80%, Apollo and Blue Owl were up 50%, even though consumer staples and healthcare were laggards last year. But again, on a 2-year basis, they're beating everything else because 2022 mattered. So that's our approach, and we don't try to time in and out of it. I don't know if NVIDIA is going up another 50% or not. I do know if it does, it's multiple expansion. And we do not invest on multiple expansion. We invest on free cash flow growth.
Do you like big oil?
Well, I love oil, small, little, medium, and big. But
you found a friend here.
I think that that's where you get the great dividend growth.
That's what I was asking.
And I think that the Biden administration policies are very favorable to big oil and very unfavorable to small oil. They're not allowing a lot of new projects, which makes the projects that Exxon and Chevron already have in the ground much more valuable. Enables them to go buy Hess and Pioneer, respectively, and their Permian market share is just exploding. So both Chevron and Exxon, we think, are great plays, but they're not our biggest energy exposure. It's midstream. So we own an ETF. The ticker is UMI. It's actively managed, has about 18 different pipeline names, export LNG terminals, but it's actively managed around that midstream energy infrastructure story. Last year, energy was down a couple percent. Exxon was down a little. Chevron was down 9%. Midstream was up 16%. The MLPs were up 25% for the third year in a row. So we do like the midstream energy story.
What gets you to sell a name? Is it they cut the dividend, or they just say they start doing stuff that might put the dividend at risk?
Cash flow or something? Yeah.
Those are all good answers. It could be opportunity cost. There was a company, Cardinal Health, we bought for about $50. It's a fantastic dividend grower. It got to 110. They continued growing the dividend. They were executing, but at that point, we got 5 years of return in 1 year, and we just exited simply to be able to pursue better opportunities. We're selling MetLife today, as a matter of fact, and that's a name we've owned for a few years. But it's a company that is not growing its dividend in cash, but it is growing at dividends per share. So we're getting more dividends per share, but they're just paying the same amount because they're buying back so much stock. When they're buying back 3 times as much stock as they are paying dividend, we don't like that. But your question about if they cut the dividend, do we sell it? It's our job to not let that happen. We need to be in front of companies that will cut the dividend. And some of the sort of career-making moments for me were deciding against the grain to sell companies we believed were at risk of cutting the dividend, ended up being right later.
So how do you identify those companies? You just see their free cash flows maybe slowing, or?
Yeah, my favorite story of all time is 2007, Citigroup, when they continued to pay the dividend and then were borrowing $12 billion from Saudi Arabia. You say, this doesn't look right to me. And I think, when free cash flow goes negative and the dividend keeps going, then they're basically taking advance on the credit card to pay the dividend.
So do you get heat from investors, though, in terms of not being in big tech and being in big oil? Because that's like the reverse of what the cool, trendy thing, ESG thing is.
That's a really good question, but we actually don't take heat for it. But a lot of that has to do with self-selection of the client base. The types of people that like working with us might be more predisposed to that. But also, we're incredibly communicative. We explain why it isn't. There's a certain ideological bend in this. Obviously, there is on the ESG side. For us, we really believe we have a fiduciary duty to find the right investment opportunities for clients. I'm not against big tech ideologically. I'm against big tech not returning cash to shareholders. I think that it is absolutely inexcusable that Apple is paying tip money out to investors when they're making more cash in a year than most of the S&P makes in a lifetime. It's just, to me, it's unfair treatment of shareholders, but I understand the argument. There's always people who ask about it, but look, Netflix was up 1,000% last decade, and it gave back all of that return in about 6 months in 2022. So I'm a child of the 90s. I grew up beginning investing money professionally in the 90s. I saw what happened. Cisco today is sitting around $50. It was $80 in 1999, and it's grown earnings and profits and revenues every year. It's executed perfectly. It was just plain overpriced. And when you buy something that overpriced, you risk decades of lost return. We're just unwilling to take that risk.
So what do you think what's a dividend yield that screens well for you? Is it by industry, by company, or do you say I need at least a 2.5% yield or something like that?
Yeah, I mean, universally we tend to want about 2.5 just to start, but there's some sectors where that wouldn't be nearly enough. The portfolio blends to about a 4 handle yield, and that's more than double the S&P. And so you're going to end up with some higher yielding names: Simon Property, Lamar Advertising.
I love Lamar. Took them public.
It's a wonderful, wonderful company.
O'Reilly Brothers.
Wonderful company. You talk about shareholder alignment. Family owns so much of it. They're growing the dividend every year. Our midstream energy stuff is over 5% yield. So you get some higher yielding names. You're going to have lower yielding names on some of these ones that it's just priced in. McDonald's, I think we talked about last time. That's a lower yield now, only because we're up 600% since we bought the stock. Same for Walmart. Walmart went public the same year I was born. They've grown the dividend every single year. So you end up with with a lower yield right now. But our yield on Walmart and McDonald's is like 40% on purchase. We're getting 40% year over year from what we bought the stock at. That's what the whole point of dividend growth is.
I just have like based off 30 seconds, right? Are you competing with money market funds in terms of getting money in clients?
No, you're always competing with the risk-free rate in the fact that people have to bench it against something, but they're not people saying I'm considering either money market or a dividend portfolio. It's a totally different risk profile. It's true in a macroeconomic sense, but it's never true in a microeconomic sense.
Good stuff.
How's the weather out in your neck
Here
of the
we
world?
go. I
Well,
knew
here's
this was
the thing.
coming.
I'm sitting here in Manhattan. The sun's out. It's beautiful. It's a little chilly. California having the worst rainstorm that they've seen, which of course there people wouldn't even, around the country they wouldn't consider it a storm, but in Newport they'll probably end up canceling school for a month.
Well, I saw some of the video coming
Looks
from the
really
storms.
bad.
And
It's pretty bad. They've gotten a lot of rain. It's a little worse inland, but yeah, we get this like once every 100 years.
Yeah, all right. Some good, hopefully good snow up in Tahoe for the skiers. David Bonson, thanks so much for joining us. David Bonson, Chief Investment Officer, Bonson Group. Dividend yields. That's one of the many reasons we like to talk to David, because it's a strategy we don't hear enough about.
It's true.
So, but
and also just how the risk profile is factored in when you take a look at the S&P dividend yield and sort of how to manage that.
Yep.
I think that's interesting.
All right, S&P 500 today, absolutely unched on the day. John Tucker's going to be scrambling for something to talk about in his reports here. But right now, let's head down to Washington, D.C. We'll get world and national news with Amy.
Amy, I think it's Amy.
Yeah,
I think
there we
Amy.
go.
Let's do it with Amy.
It's Amy.
It's Amy. Yay.
All right. Thanks, Paul and Alex. A federal appeals court has just ruled Donald Trump can be prosecuted for trying to overturn the 2020 election. The three-judge panel rejected the former president's claim of immunity. The decision moves Trump closer to trial, but he can appeal to the U.S. Supreme Court. We are, of course, following this for you. A hard-fought bipartisan deal to impose new border restrictions and unlock Ukraine war aid is on the brink of collapsing now in the Senate. Republican support for the bill crumbled in the face of opposition from Donald Trump, prompting a reaction from Senate Majority Leader Chuck Schumer.
Everyone's asking the same question. Are MAGA Republicans serious about fixing the border? Or is this merely political?
The $118 billion deal was the result of months of closed-door Senate negotiations. House of Representatives Committee on Rules held a meeting yesterday concerning the possible impeachment of Homeland Security Secretary Alejandro Mayorkas. Republican Committee Chair Tom Cole.
The consequences of this crisis have been stark and sobering, and there's hardly a community anywhere in this country that's not felt the impact.
Democratic Committee Ranking Member Jim McGovern.
Truly, this is one of the most pathetic, embarrassing things that this committee has ever done.
The House plans to vote today on 2 impeachment articles. The first damage estimate has come out of California after being bludgeoned by the weather. Bloomberg's Ed Baxter with that story.
The atmospheric river-caused wind and rain that has whipped California for the past several days has caused estimated damage of as much as $11 billion. That's damage and economic losses. This is the preliminary calculation from AccuWeather. Record amounts of rain in both northern and southern California, as well as heavy, heavy winds. In San Francisco, I'm Ed Baxter, Bloomberg Radio.
Global news 24 hours a day, whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, with this Bloomberg Business Flash. The major stock averages, they're mixed right now. 6 of the 11 major industry groups in the S&P 500, they are higher. And the best performing group, that belongs to real estate. And that's where you find shares of Simon Properties, thanks to our last guest. It's up to 6% right now. They reported better than expected fourth quarter results. Worst performing industry, that is information technology for now. And that's, of course, home to NVIDIA. Those shares down 2%. Now, aside from jobless claims, we're a little light on economic data this week. Traders also waiting to hear from various Fed officials as well. Larry Adam at Raymond James Financial sees the odds of recession dwindling as the labor market looks increasingly solid.
With those strong numbers, if they continue to come, it does narrow that path of us thinking that we're going to go into a recession, because historically, to get a recession, you need to lose about 1 million jobs. So if you continue to see that strong growth, you're probably not going to see that type of loss in jobs this year, and you could actually get that soft landing that we had been looking for.
And some more earnings. KKR posting a fourth quarter profit that beat Wall Street estimates. S&P 500 right now unchanged, 49.41 on the index. The Dow Jones Industrial Average 72 points higher. The Nasdaq 100 down 63 points. And as far as yields, the 2-year 4 basis points lower, 442. The 10-year 4 basis points lower at 411. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
See, you did it, John Tucker. He was worried he wasn't going to be able to find stuff to talk about.
Solid.
Well, Simon Properties, I don't know how I missed that one, but yeah, that's the best performer in the real estate group, which is leading the...
That's just a way to say basically nothing's happening. Overseas, though, there's some things that are happening. UBS, for example, is down almost 5%. So we want to get you some analysis here with Allison Williams, Bloomberg Intelligence Senior Analyst, Global Banks and Asset Managers. So basically, there was a fourth quarter earnings miss. It did announce a buyback of up to $1 billion in shares this year. So you can make an argument, Allison, there's something for the Bulls, there's something for the Bears. What was there for you?
So I think, investors got as much as they could today. The issue is this is it's going to be a long time frame for this deal to execute, which I think investors should have been prepared for. They may have wanted a bit more. The one negative thing for the outlook is that 2024 estimates are likely going to come down a little bit because the returns are going to be lower, but that's because I think UBS is trying to be aggressive in, pulling forward those costs. So they did upsize the costs on a gross basis, but they're going to invest those, so not falling to the bottom line. So perhaps some disappointment there. They did reiterate their sort of 3-year target. They gave a longer-term target that was in line with the high end before Credit Suisse. So I think those were all positive. The buybacks also a little bit better than expected. The big positive news was 27% increase in dividend, though also, as you said, fourth quarter, not so much great things going on there. So the miss was on costs. Their adjusted costs fell. Their integration costs or the restructuring costs were much bigger than expected. The wealth flows moderated a little bit, and the investment bank lost money.
Allison, what is the new UBS here post Credit Suisse? And full disclosure, I'm a client of UBS. Used to work at Credit Suisse, so I'm all over the Swiss stuff here. But where does UBS want to be now that they've acquired Credit Suisse? What are their ambitions vis-a-vis a global financial institution?
So I don't think that the big picture strategy has changed much for them, right? So their focus is on wealth. They're the premier global wealth manager. They added some assets. They added some relationships with Credit Suisse. In the investment bank, again, they're still focused on equities. So even though profit disappointed, revenue came in about in line. So that's a positive thing on the equities trading side of things. They did add, some incremental ads. There were some numbers around the traders. The Bloomberg News reported. We obviously look at the top line of revenue. they kept the M&A and the research areas were the areas that they added to, and those areas did pretty well in the quarter.
So what else do you need to hear to get more confidence in all of this? We need just like a kind of hold and wait for 2 more years, basically?
I think it is like a show me, right? So I think it's going to be a step by step. So Armati, as you know, said this morning that they might sacrifice a little bit of revenue because they are focused on profitability. They're focused on doing things right. So again, like those are the types of things that you have to have confidence. He has done a big turnaround at UBS before, but I think that it is the kind of thing where it's like quarter by quarter, investors have to start to see, some of the, some support for these estimates. Another target they put out there this morning was $100 billion per year for the next 2 years in net new wealth assets. So I think that's a pretty good target. But again, we saw some slowing in the fourth quarter. Some of that was mandates leaving with Credit Suisse relationship managers. Still pretty stable, but I think investors will want to see, more. So, over the next few quarters, UBS delivering on its plans.
So, Allison, you cover everything, all the global big investment banks, commercial banks here. Is the global bank, is that just left to the Morgan Stanleys, the Goldman Sachs, or whatever? It doesn't seem like anybody in Asia, anybody in Europe can compete against the JP Morgans of the world.
So, Paul, it's really been over the last decade, ever since you left the business, but
it was Paul. It was all
the
Paul.
last decade, the U.S. banks just really making those market share gains. Credit Suisse is sort of the latest to, provide some gains to those U.S. players, if you will. Keep in mind that, that sale of UBS follows them exiting prime brokerage. Before Credit Suisse, we had Deutsche Bank, who also exited prime brokerage. They shed parts of their fixed income business. If we went back to several years prior, there was a lot of the European players getting out of FICC. And, keep in mind, it is a scaled business. And I think where banks like JP Morgan have been winning, and in fact, Goldman Sachs, who has gained the most market share over the last several years, are that they are investing in technology that helps them get better revenue, that helps them have more money to invest. And so it's really that virtuous cycle that some of those big U.S. banks have been enjoying.
And before we let you go, let's talk about you cover everything. KKR doing particularly well also. What's driving some of these private equity guys to outperform at this point?
I think, if you look at the asset management industry, right, like the two areas of growth are private markets and passive. The big difference is that private markets has very significant fees. And since you've seen these big companies go public, the fundraising is just impressive.
Mm-hmm. Great stuff. Allison is the best.
She is, absolutely. I wonder who hired her. Allison Williams, Senior Analyst,
that
Global
was Paul.
Banks.
That's
Should
never
I
going to get
pat
old,
him on the
is
back,
there?
or you want to do it yourself?
Exactly. That's patting myself on the back there. No, but she's the best. Allison Williams, Senior Analyst, Global Banks, Bloomberg Intelligence. Before she came to Bloomberg Intelligence to cover banks, she was at Morgan Stanley Investment Management on the buy side.
Amazing.
As a senior analyst covering banks there for all their big funds.
I just don't like. All these banks have different business models, and I do not understand how you keep them all straight. Like, at least oil companies, like, they dig for stuff and they get it out of the ground. Like, they may dig in different places, but it's pretty straightforward.
I'm, back in college, I wrote a paper on the 5 biggest investment banks in 25 years, who they were going to be. One of them was Deutsche Bank. And for a while, I was looking really good there until not so much.
Although, we thought they weren't going to survive 2016. So we thought we were all like beating the drum to total bankruptcy or someone buying it like, UBS or Unicredit. And that didn't happen. So
and you just look at the European banks, and they just haven't evolved with the times. The governments haven't allowed cross-border consolidation. And so the net result is, in this global world, they're nowhere. Nowhere. Deutsche Bank, UBS, they're regional banks now. And it's a shame because, there was a time when you really thought that they could become a global financial institutions. So we'll have to see. Now it's up to the JP Morgans and Goldmans and the Morgan Stanleys of the world. So good stuff. We're going to have more coming up. This is Bloomberg Morning.
company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom with a look at the company news we're following. Let's start off with Boeing, the largest union there, demanding a 40% pay raise for the workers. The International Association of Machinists and Aerospace Workers says it's willing to go on strike over this. That would shut down Boeing plants in Washington and Oregon, including assembly lines for the cash cow, the 737 jets. Now, the current worker contract, that expires in September. The talks with the union and management, they are set to start on March 8th. Pile this on top of a host of problems. Boeing already facing questions from lawmakers and investors over the manufacturing problem. The latest, an issue with the misdrilled rivet holes, and the FAA has stepped up oversight and capped production increases for the 737 until quality improves. And pandemic darling DocuSign cutting about 6% of its workforce, part of a restructuring effort after talks to sell itself. They appear to have stalled at this point. The move will mostly affect staff in sales and marketing. DocuSign had about 7,300 employees at the end of last year. They've been hurt by increasing competition from Adobe's document business, and the valuation has suffered as investors lost their taste for unprofitable software stocks. KKR posting fourth quarterly profit that beat estimates, fueled by record fee-related earnings and strength in its global Atlantic insurance business. Fascinating, big take story. Kind of must read, I would say, for anybody on Wall Street. Momentous shift underway in global markets. Investors pulling billions of dollars from China's sputtering economy 2 decades after betting on the the country as the world's biggest growth story. And where's that money going? Going to India. And that's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, that's John Tucker. That's a very interesting story because we were just talking to some emerging markets, managers, and my question to an emerging market manager is, can you even invest in China? It just feels like the China risk is so pervasive.
A lot of people would agree. They
like,
would say at this point, it's uninvestable. So.
It's just extraordinary.
And also, a former enemy of the United States, also our biggest friend in Southeast Asia, that would be Vietnam.
Right, yeah. And Japan's making a comeback, so there are other places to invest in Asia, but you have to think about that for the emerging market folks. All right, right now, let's head down to Washington, D.C. We'll get rolled in national news with Amy Mars.
All right, thank you, Paul. Donald Trump can be prosecuted for trying to overturn the 2020 U.S. election. That's according to a federal appeals court, rejecting his claim of immunity and moving him closer to trial. We get more with Bloomberg's Kaylee Lines.
This is a case the president has been making for some time, the former president, that is, that he is immune from prosecution in the case that special counsel Jack Smith brought here in Washington, charging him with efforts to overturn the results of the 2020 election, that he should be immune from that prosecution as a former president, that the actions he took as president of the United States should be protected. The appeals court has now ruled against that argument, saying he is not, in fact, immune. And so this decision will now be on hold until February 12th, 6 days from now. So the president has a chance, the former president has a chance to appeal it potentially to the Supreme Court. So this doesn't mean that this is over.
Bloomberg's Kaylee Lines reporting. President Biden has been campaigning in Nevada this week ahead of today's Democratic primary. Republicans are holding a primary in the state too, but it's non-binding. Bloomberg's Jody Schneider explains from Washington.
It's the first primary in nearly 3 decades, and this will give President Biden a chance to pick up some delegates. But the Republicans are going to have a caucus later in the week.
Bloomberg's Jody Schneider tells us that's coming up Thursday night. Nikki Haley, meanwhile, getting a big boost from donors to keep her long-shot presidential bid alive. Her campaign hauled in $16.5 million in January, including nearly $12 million from grassroots supporters, and the campaign added more than 69,000 new donors just last month. Country music singer Toby Keith has died. Toby Keith, known for Beer for My Horses, which he sang with Willie Nelson, also Should Have Been a Cowboy and I Love This Bar, passed away last night. He'd been battling stomach cancer. Toby Keith was 62 years old. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg, Paul and Alex.
All right, Amy Mars, thank you so much. We appreciate that. So, Alex, as I walk around kind of like Midtown Manhattan, and you think about some of the retail space that is occupied, thank goodness for banks.
Oh my
and
gosh.
coffee shops. Those are the ones that are like every corner of the city. And now this story from Bloomberg News kind of really jumped out at me. JP Morgan Chase plans to open more than 500 new branches and hire 3,500 workers over the next 3 years, expanding into additional markets that include low-income and rural communities, as well as locations aimed at the rich. The company said it's making a multi-billion-dollar commitment with the expansion. About 1,700 locations will be renovated as part of the investment, bringing the total number upgraded since 2021 to 3,000, the New York-based bank said in a statement Tuesday. Now, for me, I'm like, why? Because don't we do everything on our phone now?
I was going to I have been to a bank in once in the last 6 months tops.
Yes. And I don't see like the bank we have downstairs is a coffee shop with like a couple tellers in it.
Yes.
So there is a business model associated. Do I come in, get my cup of coffee, hang out? How do they generate revenue for me on that?
Also, a lot of this retail space is quite expensive.
Yeah,
particularly in New York. So, what are you? At some point,
I think it's about customer service, is it not?
But no one goes to a bank.
I think it's a big billboard. I think it's a billboard. I think it's just a
straight
billboard.
up ads.
Yep, straight up just saying, "Hey, J.P. Morgan or Santander."
We're here.
We're here. I guess.
You need us. We're here. You need us. We're here.
But who goes? I like to carry some 50s and 100s around, so I will go in and change my 20s into some of the bigger bills. Because, John, when you walk into the local Jersey Shore bar, you got to put a 50 down on the bar. Just establish yourself.
Or Paul does. We know he doesn't like lines.
If you want service, because that will get the bartender's attention.
I'm not going to do the little
and
Apple
keep them
Pay
focused on you.
At the Jersey
I want to
Shore
go hang
bar.
with Paul.
That's not going to work. S&P 500, there's literally no change. It's unched on the day. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up on this hour, folks, to borrow a term from Tom Keene, we are ripping up the script. Lots of news out there, so we want to get to it. We're going to start with that Trump news, denied immunity in the D.C. case. So we have a really, really smart reporter coming to us from Washington, D.C. We'll have the